coming onto the scene in the separately managed account platforms of the wirehouses. And so that was my first foray right into managed accounts, really at the heart of its growth, and really built out a lot of services for advisors, worked with advisors. I was there for 10 years, and when I left there, I went to RBC Wealth Management, who had actually been one of my great clients when I was at the asset manager, and so I just continued working with them in the Southern California West Coast area, helping them grow their fee-based assets. And then from there I went to LPL Financial, where I was there for 10 years. And started there when there was about 3,000 advisors, left when there was about 10,000. Just really helped them build out their fee-based and RIA offerings. And then I started my own firm. So I was like, what am I going to do? You know, am I going to be an advisor? Am I going to be a consultant? Whatnot. I sort of needed a reprieve from the corporate life, management reorg, all that fun stuff, you know, and everything. So I decided that I wanted to create a consulting firm and partner with firms for fee-based growth. So partner with advisors to grow their fee-based business, partner with broker-dealers. And it was through that that I came to meet David Siegel as I was speaking on a panel at a Morningstar conference. And it was through that he made the introduction to Bill Kelly, and they all shared their vision for a new managed account platform experience for clients and for you. And so I came on board as a consultant for about 2 years. It took us a long time to kind of put the whole framework together, the infrastructure together, and kind of explain, you know, where the mindset has been, and you know where we're moving ourselves forward to in that. But as David Siegel would say, you know, there were some epiphanies along the way between themselves and myself, and I joined as a Primerican in December of last year. So. So I'm now one of you. We are teammates, and so you know, part of the reason, you know, why I decided to go ahead and join is that I just really do feel that you all are very, very distinctive versus much of the advisors that are in the industry. I would often hear from advisors, you know, we're tired. We built up our client bases. You know, we're not really sure why we're in this training. We're not really sure, you know, what we want to do. You know, maybe we're thinking of exiting the business. But what I saw here was some incredibly motivated advisors who really are focused on the care taking of each individual client that you serve. And so if I'm going to spend my time out there focused on helping advisors grow their business, then I really wanted to do it with all of you. So know that you have that experience and that commitment hear from us. So we have we launched the Lifetime Investment Platform at the end of May. And thanks to all of your collective efforts across the field, you know, we're now sitting a little over $400 million in assets under management in this platform. So thank you very much for that. How many Series 65s do we have in the room? Good, a really good amount of you. That's awesome. And how many of you have opened a Lifetime account? Great. Good experience? Mm-hmm. All right, super.
Easy application.
Mm-hmm. Super. So what I'd like to, you know, get into you with this evening is, and it's a lot, and I'm going to try to make it feel a little more like the garden hose than the fire hose, but there is a lot of information, and I kind of want you all to, you know, to tell me, you know, what do you need? You know, what information would you like to have? Because there's a number of different things we can look at and concentrate on. But one of the things I wanted to do here was kind of give you some context on, you know, what is this platform? Why is it industry leading? Where does it sit in the marketplace? How does it give you opportunity? Because I think that's really important, because you have to really believe in this and really believe that this is a business model that's really going to be fair and equitable to your clients, that's really going to help them solve their problems. You know, it's great as Tony introduced, you know, the great, you know, financial opportunity that it presents for you and your business model, the most important thing is it going to be good for your clients, right? So we'll talk about that. We have a couple managers here with us tonight. We have Lauren is here from Invesco, and Andy will be here from Meter. So we're going to hear just kind of 30-minute segments from them. What are they bringing in this platform? How can you use their models to solve for clients? I'd like to talk a little bit about manager blending, show you the dashboard a little bit, and then we'll get into pricing and positioning. So how does that sound as an agenda?
Yeah.
All right, and feel free to ask questions. Let's just get as interactive, you know, as we need to on this. We're going to see is the first time I've tried to use this this remote. No, I think it wants to work for me. So this is a little history lesson, and this kind of goes to, you know, helping you understand, you know, why is fee-based business an enduring business model? I think there are still sort of skeptics out there after all these years. Some think it's bad, some think it might go away, but it's really not. And it's actually interesting because fee-based business, the beginning of it, the origins of it, go back to 1975, right? And there was always, we see a lot of really great sort of defining things coming to the industry, enduring things coming to the industry at points of regulation change. And so in 1975, we have what we call May Day. And May Day was the abolishment of fixed rate commissions. So the entire industry was sort of dictated by the regulators on how much they had to charge for commissions. And commissions were really expensive. They were like $25, you know, $36. I mean, really expensive. And so this deregulation became really important. And what happened is when they said, you no longer have to charge fixed rate commissions, every broker-dealer, every custodian can charge what they want. That meant really that that ticket charge price could actually go down to zero if the firm wanted it to. Well, Charles Schwab saw this. Charles Schwab was actually on the verge of bankruptcy in 1975. He owned a broker-dealer. And he was a little like, I'm not sure if the advisor's going to do it for me. I think I'm going to go back directly to the client. And he said, if these commissions are deregulated, I can just charge, you know, $5 a trade, and I'll do this business with clients directly. Hence, Charles Schwab was born, right? And we see it, the behemoth that it is today in the industry. Now, does have an advisor segment of that again. There's always this sort of constant, you know, push and pull with that, but that was how he started. Now there were some other pioneers at this time, and that was John Lockwood. And yes, that is the pioneer of Lockwood, Jim Lockwood. And you know, later on, Jim started Lockwood Advisors, who you all know as the Advisor to Freedom, and also within Lifetime today. But you know, Jim had been working in institutional consulting. He'd been working with institutional money managers, and it was his dream that he be able to work with money managers to bring their minimums down so that he could work with individual investors. This was his aha moment with this point of deregulation. If these trades could go to zero, he could just create a fee-based agreement with a client and with a money manager, and there would no longer be any trades. He could freely provide advice, he could freely hire a manager, they could buy and sell as they needed, and it would be a lot more economical for the client. So he went to Morgan Stanley at the time, which is Dean Witter really at the time, and Shearson, and convinced them of this, and that was when the first fee-based account was born. And we all know another great pioneer, right, and Art Williams around this time, right, who said we gotta come with term life insurance. So, you know, this was all about changing clients' lives, getting clients access to new services. So you fast forward, you know, a lot of this stuff was just really done on paper, you know, window dressing, if you will, and it was through technology advancement during this time in fee-based that in the 1990s, it was early 1991 when I told you I started at that asset manager, was just getting on these fee-based platforms at the wirehouses. They were the first to entry point with technology that would really allow them to manage manager models in a more effective way. In 1995, the Tully report was really a validation of this fee-based business model. The SEC commissioner asked John Tully of Merrill Lynch to form a commission. So he brought folks like Chip Mason together, he brought Warren Buffett together, very esteemed investment professionals together to measure the merits of fee-based business and retail business, commission-based business. And the outcome of that was that there was a clear validation for fee-based business model in respect to clients. They saw higher client engagement levels, they saw higher client retention levels, they saw clients feeling much more aligned with their advisor, and they could see that on the retail side that while those were viable instruments for clients to get early starts in investing, there were still inherent conflicts in there because the product manufacturer was paying the registered representative to sell the product. The commissions were not being paid out of the client's pocket, they were being paid by the product manufacturer, and that presents a conflict. So these conflicts were addressed, but nothing was changed in the way that we did business in 1995. If you read the Tully report, you'll see sort of threads of what came out in 2016 in the Department of Labor rule, actually. So we've come through a lot of, the whole point of this chart is fee-based business model has come through regulatory change, it's come through economic change. Every time there's been a market event, whether it was the tech bubble, whether it was like even Y2K, you know, we had the E-Trade baby, you know, come. Nobody's ever going to hire an advisor again. You know, when these bubbles break, when we think there's pressure from do-it-yourself, you know, nobody's going to hire an advisor. They're all going to, you know, buy trades from the baby. You know, it didn't happen. We haven't seen it happen. And so and we had the Department of Labor rule, which again was kind of a validation of this fee-based business model. A lot of aspects, again, of cleaning up the conflicts, making it level fee compensation no matter what the product is. A lot of things. So fee-based is continually endured. It's a sound business model. It takes a client and it takes an advisor to want to do this. It's a contractual fiduciary relationship between the two parties. Is it always perfect? No. But at the same time, it really has given great benefits. So it is a business model that you can stand on, that you can really build a framework around in the way that you want to engage with clients. And today, you know, this is really, you know, a significant industry, you know, in terms of, you know, almost a, you know, $4 trillion industry in terms of the assets that are between a financial advisor and a client. You know, the entire wealth industry is about $28 trillion. So this is a significant portion of the way that clients do their business today. This is not going to work. So there's industry trends too that are in our favor today as being an independent broker-dealer, being independent objective advisors. And, you know, one of those comes from the fact that the baby boomers, you know, they're retiring. And the baby boomers have been part of that huge do-it-yourself boom. And now they're sort of waking up and they're thinking like, oh my goodness, am I going to have enough money if I live until I'm 102? How am I going to do it, right? Healthcare costs, inflation, considerations, all these things, how am I going to do it? And they're raising their hand, they're saying, I need an advisor. And the studies are telling us that they don't want to go to a wirehouse and they don't want to go to a bank. They want to go to an independent fee-based advisor for that advice. And their children, the millennials, they are on the rise as well. They are inheriting assets. They're inheriting a lot from their grandparents right now. Soon they'll be inheriting from their parents. But they also, there's a whole realm of this millennial population that actually have really good paying jobs, that have actually been saving and have material money to invest. And so they're interested in exchange-traded funds. They're interested in advice. In fact, some of the surveys that have been done recently by Charles Schwab and by other planning financial planning organizations show that millennials want advice and they're willing to pay, $1,200, $1,500 for a financial plan. One of their issues right now is they think that implementation is commoditized. They think all ETFs is the #1 investment among millennials. But they think that exchange traded funds, ETFs, are all alike, but they're not. There are market cap based exchange traded funds, there are fundamental weighted exchange traded funds, which you're going to hear from Lauren here in a little bit from Invesco. There are thematic funds. There's a handbag ETF, Louis Vuitton, Chanel, Michael Kors. I mean, you can buy a handbag ETF, or you can buy a bourbon ETF.
Oh,
Wow.
Bourbon, whiskey, fine wine, if alcohol is your, thing. But then on the other spectrum, we have socially responsible investing. The realm that the millennials like. But, the #1 ETF, was a 3 to 4 times ETF leveraged, oil leveraged ETF. So the millennials, they need advice, and they need to know that they can have a personalized investment plan, and Lifetime does that. And then the final category is what's going on with the industry advisor. There are industry advisors who are clearly in flux. There are industry advisors who are aging and do not have a succession plan. We have about $2.3 trillion under management by advisors 63 and over. And for them not to have a succession plan, not to know what they're going to do for these clients is really critical. And so they're looking for those opportunities out there where they can join with other advisors. You have a lot of discontent out there in the broker-dealer community. And so, Primerica, with a lot of the advantages that we have broadly through our broker-dealer and through our parent, and what we're doing in building out platforms and capabilities like Lifetime, could be another really interesting way for you to grow your business right now. So, how do we design this platform? And these are just some of the key features. One of the things we did is we built this with simplicity. So while we're living in an industry today that has a platform alphabet soup, if you go look at any broker-dealer's ADV, you'll see that they have mutual fund rep this, rep as portfolio manager this, separate account manager this, all these siloed platforms. A lot of it, some have 20, some have 30, some of it has come from acquisition. I look at, somebody called me the other day and said, can you help me make sense of Raymond James platforms? And I'm like, well, which platform? And you look at the ADV and there's like 15 different managed account platforms. We only wanted to create for you one state-of-the-art unified managed account, meaning that we can hold multiple securities in a single account for a client, meaning we can hold multiple manager models in a single account for a client. When you look at our ADV, it describes Lifetime. It's incredibly transparent. The pricing is outlined. If a client does decide they're going to read the ADV and they compare it to the presentation that you've given to them, it's going to make sense for them. So it's simple. So we have all the capabilities under one umbrella, and all we have to do is to give you more capabilities, more managers. All we have to do is add to this platform. We don't have to create a new platform every time we want to bring capabilities to you. So it allows you for that seamless execution for your clients. We have an objective due diligence process. One of the things we see out in the industry today is that most broker-dealers have their own internal research department, or they manufacture their own product. Back in the day, the research departments of most broker-dealers was there to provide a recommended list of mutual funds or exchange-traded funds or separate account managers. And they've gone further than that now, and they're building models, and they're putting models on the shelf to sell for clients. And they're not holding themselves to the same standard of due diligence that they would the third-party managers that sit on other platforms that they have. This creates conflict of interest, if you will, because do you think that if a researcher's group's own models are underperforming, they're going to tell you to fire them as an advisor working for that broker-dealer? Most likely not, right? And then we have the other genre of this, which is what's called rep as portfolio manager. So when I talk about that, $4 trillion that's in fee-based assets under management, about good 50–60% of that is being managed by an advisor who is also acting as a portfolio manager. These two roles have become blurred. And so they're responsible for the asset allocation for the underlying mutual fund, ETF, or stock selection. Do you think that this advisor acting as portfolio manager will fire him or herself when their portfolios underperform? Most likely not, right? I mean, great prolific example of this was a gentleman who came in who, was thinking of, maybe becoming an advisor with PFS Investments, and he said, I got to tell you, I'm not sure I want to be in this business because my lens on this is that I had a really nice $300,000 401k coming out of my company. I gave it to an advisor who was acting as rep as portfolio manager. When he was done with it after the 2008 crisis, I only have $30,000 left. And this is what happens. And what we're seeing often, I'm seeing this every week, my team is coming to me and saying, Tracy, we have this case, that case, this case, where the client doesn't understand how the current advisor is managing the money. They don't understand why these securities are there. They don't understand how much they're paying for it. So this is not really connecting with clients, this format. And so it's one of the key reasons why we decided to build this platform differently. And I really, to me, this is it's as prolific of a topic as probably, when Art Williams, was going up, with term life against whole life, and just really setting it out and saying, this is why, that doesn't work and why, we believe term life is the right structure and the right cost and the right, way to enter into an insurance policy. This is sort of that moment for us in investments that we're bringing to clients, that we have an opportunity to share with clients, is we looked at, should we create this rep as portfolio manager managed account, or should we create a third-party professional asset management program? And what we settled on is we know that this rep as portfolio manager is under scrutiny by the regulators right now. It has conflicts of interest that do not jive with the Department of Labor rule. It has conflicts of interest around being a fiduciary and what's in the best interest of the client. And so the regulators are looking at this. They're looking at the potential underperformance of these types of platforms. And so we said, it doesn't make sense to enter that space knowing that it's under scrutiny. But moreover, it doesn't make sense to enter that space when we think those who have joined PFS Investments to do securities for their clients want to be that relationship manager, want to be that cornerstone of the client's relationship to help them understand their goals, their risk tolerances, the outcomes. And then we think that you don't want to be the portfolio manager. You want to hire a portfolio manager who spends 100% of their day watching the markets, building portfolios, has accesses to the resources on the street. And so there is a clear line of separation there. So if anyone in this equation needs to be fired, it'll be the manager, not you, right? There's a distance there, right? When this is all together, everybody gets fired, right? When there's a distance there, the roles can be clearly delineated, and then therefore the responsibilities, the responsibility for if something goes wrong laid where it should be, if you will. So that's how we built this. And you know, one of the things I tell clients when I meet with them is you're never going to see Primerica on a mutual fund here. You're never going to see Primerica's name on an ETF or a variable annuity. Yes, if you're, you know, have a Fidelity plan, you probably see a lot of Fidelity product in your 401k plan. You won't see that here. You're going to see something very independent and objective. So we don't manufacture product. We don't have an in-house research group building models. What we've done is created an in-house research group and an investment committee to go out and seek the best professional asset managers who can accomplish an accumulation for clients, who can accomplish preservation, can accomplish income generation and income distribution. That's what we're looking for. And we work with an outside independent consultant named DeMaio Schneider, who's one of the top pension consultants in the United States, that acts as a fiduciary, that understands ERISA law, putting plans together, and understands independent investment options. And we rely on them as another set of eyes and ears to look at our managers, to help guide us, to help give input on who we put on this platform, who we take off this platform, who we put on watch list. And we do an annual due diligence. We did two years of annual due diligence on these managers before we went live with this platform. And we'll be beginning our quarterly due diligence on these managers. And we look at the people, we look at the philosophy, we look at the process, and if those three things are operating on all cylinders, you should see the performance. Performance is an outcome of people, philosophy, and process. You're going to hear us talk a lot about the 4 Ps. But it's this independent, objective due diligence process, the ability to hire, to fire, to move clients out of managers that are not working. For you to be the one who's providing that, who's overseeing that as coach, as general manager, and understanding that and knowing when you need to take someone off the field, when you need to put them back on. And what a sad overtime game for the Bengals. It was just tragic. Time on that. But you know, that's sometimes how it goes. So this is something that I really want you to take hold of, you know, grab hold of, because this is really our distinction. When I happened to be in Burbank, and advisors had me meeting with some clients, and I had this one couple, and she said to me, you know, I think we're really happy with our Fidelity 401k plan. I'm not sure that we want to move. What is it that really makes you different? And I said this to her. I said, what makes us different is that you're never going to see our name on the product. You're not going to see it. And I said, do you see Fidelity in that 401k? And she said, yes. And so I said, let me talk to you about our independence and our objectivity. And I went through it with her, and at the end of it, she was like, well, I have some money. I want to do that. But that's the connection that you have the ability to make, because you're really independent, you're really objective, you're very transparent, and you'll see how we built transparency even further into Lifetime. So this is the big difference right now.
Question, please.
Yes, sir.
All of this is still, though, based on the market, right? I mean, if the market goes down and then the trend of going down, everything's still going to go down. Is that not correct? Regardless to who's managing?
It may go down, but the question is, how little can it go down? And we believe we have managers on this platform who use risk management techniques to put up a floor around that client so that they lose a lot less. They can have the tactical flexibility to be able to move clients into cash when they see volatility in the markets. They do not have to stay 100% fully invested. So we want to get clients as many levers of control in their investing plan as possible. You know, I think you've been traditionally used to more of a buy and a hold approach with very product-specific, theme-specific, market cap-specific mutual funds that don't really have these capabilities. They're forced to kind of stay within a mandate within their prospectus. Here it's very different. We're offering separately managed accounts for clients. the manager has control over the individual securities. They have control over the techniques that they can bring. We have some that are still strategic, that are gonna ride it out. They're gonna try to ride it out by the way they control the asset classes, by the way they control the weights. But we have other managers now who can actually begin to move a client out to cash. They have other levers that they can do, and we'll talk a little bit about that with Meter. You know, Meter is a tactical manager, and they have that flexibility. Invesco manages risk through some different techniques called a low volatility exchange traded fund to kind of dampen that risk. So we're bringing different competencies to the table.
I have a couple of questions and I've probably gotten a little light into but you had, what was it, Demio Snyder?
DeMaio Schneider.
DeMaio Snyder? If I'm talking to somebody, what is their role?
So DeMaio Schneider is an outside independent consultant that we bring in to help us facilitate our due diligence process.
Oh, okay.
So rather than just Primerica doing it, we have this independent party that will go out and visit all the managers. They'll administer the RFI.
So Lockwood before on the Freedom did,
They did not have that,
okay.
right? There really wasn't a due diligence process in place. You know, there was a general oversight, but I would not say the kind of due diligence process that we have now. So now with Lockwood being a manager on with the other 5, we are really looking in the hood on what Lockwood is doing and subjecting them to the same annual RFI process and the same quarterly RFI process. So if they're, you know, with any of the managers, if there becomes a pattern of systemic underperformance that cannot be accounted for rational reasons in the market, rational reasons in their philosophy, they could be subjected to watch list or removal.
And what I'm, I guess is more, this is a question, I guess, Jeff, I have like between 2 and 3 million on the Freedom platform. So that means I have 30-some clients that are, and so talking to them is why, they're going, well, why are we changing? And so what I'm looking for is what's I mean, I've talked to some already and just gave them a heads up that we will be changing, I'll be talking to them.
Yep.
But to give them a good, I guess, I'll say one-liner, but a short explanation of why this is moving, and then I guess the process will probably show them that they will feel it too, because I haven't done that process yet.
Right. I think the number one thing that you can tell Freedom clients, the reason why we're moving from Freedom to this brand new platform is because with our new platform, we have a new custodian, and that new custodian can support lower share classes and can support other investment vehicles. And so one of the things we felt strongly about was lowering client costs. And so this allows us to move out of A shares with 12B1 fees and move them to institutional share classes, roughly taking about 25-30 basis points of internal expense ratio costs down for them. And on that basis alone, that's important for them to move. Now, yes, there is about 52 basis points of transparent cost that they pick up, potentially based on where they are. But that's to give them this capability, to give them access to new managers, to give them access to better statements and performance reporting to gauge how they're doing. But when that offset is done, the transparent cost pickup and the reduction of the internal expense ratios, you either make it even or cheaper, depending on if you diversify with another manager, like an ETF manager, you can ultimately make it cheaper. And that's just all, you know, and the other way to make it cheaper is if you want to lower from your 125 fee down, you can actually make it less expensive as well. And we'll go through that in the pricing scenarios.
Okay.
So one of the other things we did is we really wanted to focus on the client with this platform. So there are a lot of platforms out on the street today that are just supermarkets. They just have massive and massive amounts of mutual funds, ETFs, separate account managers. There's one platform, which is kind of a technology platform, that most of the independent broker dealers just took hold of this technology platform, slapped their logo on it, and said, we have a managed account platform. Well, hooray, you have over 13,000 security types on this platform. How are you going to decide what's good for the client? Very difficult to do. So we wanted this to be an extension of your conversation with clients. So Lifetime is built on a client's investing life cycle, right? Clients, they're young, they go through their accumulation phase, they move into their 40s, 50s, they're starting to think about retirement. They don't want to lose the money they've accumulated. They want to preserve it. And then they move in, some move into, I need more yield, I need more income generation, I'm not quite ready to distribute it all. And then people move into that final phase where I'm no longer working, you know, I now am going to draw down these assets. This is going to create a paycheck for me until I'm age 102, potentially. You know, women are living much longer. Women are outliving men. Every week I hear, oh yeah, I got a 90-year-old, I got an 85, I have a 97, I have 102. My parents just got back from seeing some family friends and their mother is still alive and she's 102 and kicking, you know. And it's like, what do you do about longevity for that? So that's how this platform is built. It's about what do you need? What are you trying to accomplish? It's not about, oh, you know, what standard deviation do you need or what's the Sharpe ratio, you know. It's not about a statistic. You know, it's not necessarily always about a risk profile, but it's about what are you trying to accomplish? What does this money mean to you? And so one of the things we've done in Lifetime is we've built into it clients' preferences, a filtering tool that allows you to do discovery with client and capture all of these inputs from them. And you may talk to a client and they might say, I have no idea what strategic or tactical is. Well, that's great, let's talk about it, right? And then you have a super educational opportunity to talk about what these investment concepts are and how you can help, right? Isn't that what we do so great with our clients, right? Is we educate them first about financial concepts and build that relationship and build that rapport so that when it comes time to truly talk about how we're going to implement, they can understand it. So, you know, where are you at in your investment life cycle? What do you want for market exposure? To your point, you know, do you want to stay fully invested or do you want something a little more flexible, adaptable? Do you need to be tax aware? Meaning, do you really need to put the management of taxes above your investment performance? You know, are we going to let the tax tail wag the performance dog? You know, do you need muni bonds in that? Do you want a manager who's really, you know, going to manage for taxes before performance? And investment holdings, ETFs, exchange traded funds, mutual funds, or a blend of both. What do you want? All of these are great conversation starters. They're great opportunities to dig deeper. And when you can get these inputs and you put them into the filtering tool, and the filtering tool now takes you from 6 managers, 45 models, down to the one that's most aligned for your client, do you think there's going to be trust there? Do you think there's going to be commitment there to move forward? Absolutely. And so we're hearing advisors, and maybe those of you who have opened Lifetime accounts, depending on whether you've taken clients through the filtering process, but some of the testimony I've been getting is my clients love to sit there and watch us take them through this filtering process. Because when we get down to what those manager choices are, and we reflect on those managers, and it's down to 2 or 3 choices, we know exactly what we've chosen and why we've chosen it. A lot less disconnects in the process. Choices are important. Again, not 13,000 different choices that are ultimately decided by risk tolerance or statistical information, but choices that again are based on those clients' preferences, goals, biases, needs. And the goal here, the reason why we call this platform Lifetime, right, is we want your clients feeling like they can stay in here for a lifetime. One of the biggest issues, you know, with Freedom was you only had one manager. And if that manager's investment philosophy isn't working, if the technique is no longer valid for the client, you have nowhere to go, right? You can only go back to retail, you know, which isn't a great way if you're really trying to position yourself as a fee-based advisor. And so we want you to have choices so that if one of these managers in accumulation isn't working, you have another one to go to. Okay, so you always have bench strength, you always have flexibility in that. So it's 6 managers, 45 models, but we've also given you this ability to combine up to 3 managers in one account. So we have these account allocations built where you can create a 50-50 mix. You can do a third, a third, a third. You can build your own custom allocation, 60% with equity, 40% with fixed income. You can bring specialty managers. It's well over, and don't let this daunt you, but I mean it's well over 500 different combinations you can build with 6 managers, 45 models. The capabilities here to manage around risk, around experience, around the outcomes you need for clients, it is really outstanding, and to be able to do that in one account is huge. So we've created a dashboard just for you to enter into on Primerica Online, and you are able to go in and manage your entire business here. And so this is one of the things where every year there's an independent broker-dealer report card that comes out on technology, and most of the broker-dealers out there are getting a D- in their technology. They're not necessarily investing in it, they're not necessarily focusing on the right areas. And so I would say, you know, it's one of the things on the retail side, firm has really tried to make that very simplistic for you with Turbo, make it very easy for those applications to be put in when you're using the platform. We've tried to do that here. So this is your portal to come into. This is state-of-the-art digital. This entire platform is digital. This platform can go up against any robo-advisor out there. It can go up against Betterment, it can go up against Advice Engine, it can go up against Vanguard's Robo, Schwab's Robo Intelligent Advisor, any of them. And we've just chosen to do it with you at the helm of it, with you steering it. But when you get into it, you go through the filtering tools, you go through the manager selection, and then you have the client sign with DocuSign. It meets every item on the checklist from the industry consultants on what a digital advice, robo-advice platform is. But so that's the capability that you have. You can open accounts, you can do Service Express and do contributions, withdrawals, model manager changes, fee changes, all from the portal. You can look at performance on your client accounts. You can look at fee transparency. It's all here. This is the screen where you go in and do the filtering. So here you would come in. The system is smart enough to know what the potential assets are of the accounts. In these drop-down boxes for account allocation, it'll drop down. Are you eligible for the custom allocation, the predefined allocation? Can you hire 1, 2, or 3 managers for this? You can plug in your filters here, and this will get reduced, get reduced, get reduced. Okay, super easy to use, super easy to walk a client through this process. We have advisors who do this themselves, and we have advisors who do this with their clients. It's up to you how you want to create that experience. One of the things with the millennials is they love this sort of gaming technology. You know, so this is a great thing to show a millennial because they want to be engaged in the process. They want to understand what is happening. And so this is a great way to have them be part of that. Here you can see in the filtering, you can also put in no preference. You know, some clients may not have a preference, and you can say that's great. And one of the things our proposal tool does is it documents all these preferences. So you actually have a record of what the client said were their filters. And so if they ever have a question, how did I wind up with this manager? You can go back and look at the proposal, look at the account documentation, and show them that. And easily correct it if anything is wrong. Over here, we have analytics built right into this screen. Now, this filtering tool can be used from the new account opening process. So you could just start opening an account and not even know what manager you're going to choose for the client and work through this process in new account opening. You can do it in proposal. Proposals are not mandatory for account opening. So you can do it in proposal. But we also have this as a standalone little widget that you can go to in just a research section and just play and tinker and try to figure out how you want to design this for the client. But here you can compare up to 3 managers. So when you click these boxes, your analytics are built right in, and they'll just pop up and you'll be able to look at the manager's holdings, best worst returns, performance information, sector analysis, bond analysis, pricing, internal expense ratios. Everything's right there at your fingertips, making it easy for you to discern, again, which manager you want to hire for the client. So, leading custodial platforms, one of the things we've done, we're completely integrated. So again, with TD Ameritrade as one of the top custodians in the country today, they were ranked by J.D. Powers as the #1 trading firm on the street. When you, as a broker-dealer, are sending thousands and thousands of transactions to your trader, you want to know that they're going to be able to execute, that they're going to be able to get best price execution. And especially for exchange-traded funds, individual stocks, and TD is that for us. We could have never entered the exchange-traded space if we had stayed on the record-keeping platform of BNY Mellon. That's like literally being in the caveman days. You are now in Odyssey and beyond. You know, like imagine whatever crazy space movie is out there right now, like that's where we're going. It's like off the charts in terms of our capabilities. It's not a matter now of what we can do, it's a matter of does Primerica want to do it, okay? So one of the things we did is we're doing model management. So all of these managers are contracted with us to send us their models, send us their buy-sell decisions. We implement that. Primerica is responsible for portfolio management, trading, rebalancing, performance reporting. What that allowed us to do was move these managers from a 50 to 80 basis point price point to 0 to 25, okay? And so Primerica is handling the entire platform from account opening through all those functions, like I mentioned, trading, rebalancing, performance reporting, fee billing. We're doing all of that. None of that is outsourced. The benefit to you over time is going to be as we put assets on this platform and we build scale, we will get pricing benefits from our technology partners that are helping us manage this platform. TD Ameritrade, they are your traders, they are your books and records. They provide the monthly statement to the client. They provide a client portal so clients can go in and look at their balances. They're providing a structure for us where we can set up a non-program account for a client. So tremendous uptick in capabilities, fully integrated with DocuSign. No additional cost for that. There are firms out there that integrate with DocuSign that charge advisors additional cost for that. We're not charging extra for that. The client online access through TD Ameritrade and Fiserv is basically our middle office provider, allowing us to make all that sort of multiple manager capability available for you, bring that transparency and managers and billing to you.
Is there a cost on the American trade?
No. So, well, we have, yes, there's a custodial cost that we've negotiated with TD Ameritrade of 10 basis points, which if you go to any, basically, RIA with substantial assets that's using TD Ameritrade as their custodian, their AUM rate is going to be 20 to 25 basis points. We started this platform at 0 assets with TD. They didn't know if they were going to get any of the Freedom assets. They had no idea. So but they started us at 10 basis points. Unheard of. And if we can get this platform to like $1 billion by the end of the year, you know, we have more negotiation to do with TD Ameritrade and with our manager partners. So scale drives costs down. You want to see these costs get driven down, put some scale on this platform, and it'll make a difference. We have transparent account pricing. This study that came out last year was very stunning in terms of telling us what clients' feelings are about their fees. So they know they pay a fee, but 60% of them do not know how much they pay. The fees are not transparent. Any of you here, as you start talking about this, you're going to get Edward Jones statements, you're going to get LPL statements, you're going to get Raymond James statements. We've seen them all, and the fees are not transparent. Our fees are transparent. This was one of the things that the Department of Labor really wanted, and it didn't really come out fully, so most of the firms didn't change. I know just a few that set it out. But what we're doing is we're setting out what the advice fee is. We're setting out what you're going to get paid for your services. We're setting out what the admin fee is, what the custodial fee is, and what the manager fees are. So we are absolutely 100% transparent, and clients can attach a value to these individual services. You can have a much better dialogue about here's what I'm worth, here's what you're paying in sort of administrative fee, custody. Is it worth it to get the statements? Is it worth it to get the tax reporting? Is it worth it to have the client portal? And then here are our managers. Here's what Horizon's getting $128 a year. Do you think Horizon or Morningstar or Meter, which is charging zero transparent strategist fee, do you think any of those managers are going to be able to produce enough performance to pay $128 a year? Yes, yes. Clients need to, it's not about putting this entire fee amount on the back of these managers. These managers have a role, they have a responsibility. They need to be showing that they're giving enough value for $128. You, as the advisor, the client's paying this out of their pocket. Do they feel good about the advice you're delivering? Do they feel good about how you're keeping them in the markets? Do they feel good about how you're helping them make these choices? That's what they're paying you for. That's your value. In a transparent pricing model like this, the psychologists will tell you that clients are more aligned, they're more likely to engage in it for the long term, they're less likely to question it because they bought into the value proposition, service proposition of each one of these. So our client and advisor support is for everyone. We want all to manage, to be able to grow this business. So we have the concierge desk, we have our managed investment consulting team, which is the team that I built out to just really focus on your business growth, helping you understand the managers. So we have operational support, we have growth support for you, we have all of the money managers. But this is not based on GDC, cash flow, status. This is based on, do you have a Series 65 and do you want to grow in this business? It's not something, these services are sporadic in the broker-dealer community today. Operational support is sometimes only given to those that are the 6-7 figure earners. But I think it's a real, distinction that we have here at Primerica in terms of the support and the business building mentality we have. And just the final thing I'll say, that just kind of, when you put, what PFS Investments, what Primerica is doing as a company overall tied into the lifetime investment platform, the opportunity to build your business with override opportunities, to basically build out your own independent business with recurring revenue stream as a core component of that, being able to bring this process of client engagement, it's incredibly empowering and it's something that most advisors can experience out there, given where they're at. They have the managed account bonus program, they have opportunities to get Primerica stock, company and security trips that are focused about empowering you, hearing from your peers and your colleagues, ownership opportunities. You know, right now, you know, I went through some valuation pricing exercises with the team that sort of leads the ownership area. And you know, with the way Primerica is structured, you know, when you hit that $300,000 in cash flow, which you could do on a $50 million book exclusively of fee-based assets at Primerica, you would need to do nothing else but generate $50 million in fee-based assets, charge a 1% fee, go into your RVP payout, and you would have full ownership at $300,000. You'd actually be at $330,000. It's huge, and then you can combine that with other things here. But the way that Primerica is valuing a practice right now is about 6 to 7 times cash flow versus the industry for a fee-based practice at 3 to 4 times cash flow. And in retail, if you're just doing retail, 1 times cash flow. So there is power in this fee-based model. So the excitement is there, whether you want to, you know, develop this business through clientele, whether you want to build it through building out your business by bringing other advisors on board who want to work with clientele. There's a lot of different ways to go about it. But at the end of the day, what Tony was describing, that red line, which this is just showing 1.25% gross, not going to your payout level here at Primerica or anything like that, but $917,000 over 10 years versus if you just did retail for that same amount at $587,000. So, you know, the opportunity is yours. It's yours to take hold of this as another tool, you know, in your toolkit and build it out. But I think we have a great advantage in the industry. It all starts with each and every one of you and how you want to serve your clients, how you want to engage with your clients, how you want to build, you know, your business for the future good on behalf of your clients. You know, one of the reasons why so many advisors in the industry turn to a fee-based business is that they wanted to ensure that they had a recurring revenue stream, to be able to have an office, you know, like this, to be able to bring clients in, to be able to build out staff, to be able to build out marketing programs, service programs for their clients. There's just so much more to be given back to clients potentially in this model. So that's really, you know, our framework. It's the rationale for why we built this platform, what we think we're going to bring, what we know we're bringing already, I'm going to say, to this industry. You know, we are seeing Primerica advisors creating great relationships with clients and gathering in new asset capability. You know, with the ACAT transfer capability that we have with TD Ameritrade, the ability to fund accounts with securities, you know, the ability to bring over those assets, clients don't have to liquidate them. With the ACATs, you know, we just go in and take over the assets. It takes 5 days for those assets to leave a firm and come here. We just took over a $10 million account from UBS. We're doing it all through ACAT transfer. 5 days. About $10 million here for that client. So we're working with the high net worth. We're working with clients who, you know, are meager standing, if you will. You know, $25,000, $30,000, $50,000, you know, $1,000 in their portfolio. But we're able to align with them on solutions. You know, if you look at where we were in terms of brand new account flows, and I'm not talking about retail transitions or freedom transitions. But if you look where we were a year ago with just freedom on new money flows, we've doubled that since Lifetime has been open month after month after month. That's a testament to what you can do, to the conversations you can engage in now, and how you can really begin serving client needs in a way that you couldn't before. So, exciting?
Yeah. Oh, yeah.
All right. Awesome.
All right, so Lauren's up next. You want to intro
All
her?
right. Yeah.
Hey Jared, I got a PowerPoint for you for Lauren from Invesco.
Oh, does she have, okay, because I have one for her,
Oh, you got it too?
if she wants this one, yeah. Question?
Sure, I have a quick one, I hope it's a quick one. In having these conversations with people, what material do we have to go over with clients? Is it all, if we have, when I did the Freedom platform, I used the Freedom brochure along with the proposal.
Yeah, so what you have, and we'll go over this as well, but what you have available is the client brochure and due diligence piece that is on your chair there when you came in.
Okay.
And that's available on the dashboard and on POL. You can print the PDF image, you can take it down to Kinko's, print it, take it down to Staples, or you can order those. I think they're like 2 cents each, already printed through publications. We also have, if you're interested, we do have a client presentation where you can customize the front cover. So you can say, prepared by Tracy Gallman for client John Smith. And then it's a can slide. So some people like a presentation format over the brochure. So that's available as well. And then we have the proposal is also available for you as well on the dashboard to present. And then coming very soon, we're going to have a generic sort of managed account piece, just very generic. What is a managed account? A managed account is a process for investing. And so it's all about the process of managed accounts and the key tenets. And if you want a sneak peek on the piece, you can join my webinar Wednesday at 4 o'clock to hear more about that. And then we have a really great customized fee and services template that's coming that you all get to customize with your name on it and put in your advice fee schedule and present that to clients when you want to talk about fees. So some new, and then already out on POL and out on the dashboard are 3 client-approved letters that you can use to introduce the concept of the Lifetime Investment Platform to your Freedom client, to your retail client. You can also use it to introduce it to someone that you're just prospecting. But they work great as scripts. They work great as mailers as well. So those are already out on POL, out on the dashboard. And then also coming soon, I have seminar announcements and ads that you can put in different little trade publications or local community newspapers to promote that you're a fee-based advisor and that you do process-oriented investment management. So a whole lot of things to help present yourself. Does that help?
Yes.
Thumbs up, good, sound like good stuff?
Question back here.
We've been using 1%. Do you have any recommendations? If you get, just based on what the industry is, when you get to a certain amount, million plus 0.75 or any kind of a guidance on that?
Yeah, so definitely right now, we are still pretty much, the industry is still very much holding strong at 1% industry average. And so I highly recommend that up to $1 million. At $1 million, you'll notice we give you the opportunity to discount further. And so you can definitely, I would start looking at doing that. So probably, $1 million to $2 million coming down, probably into the 80s, the 70, 80s, somewhere in there. Over $3 million, you're definitely going to want to be around 50, 45, 50 for sure. And then, things when you start getting into 10 million and some of these other kind of cases, call me and we'll work through the pricing, because I do for the larger accounts, I can do some creative things around manager pricing, admin pricing, things like that. So, don't hesitate to call on that.
Thank you.
And the one thing I'll just say, is just, I think it's okay. I mean, we set the band at 125. We did that primarily to help those of you who are doing freedom transitions to move, to just do a lateral move and not have your compensation impacted. But I want you to be cognizant that that extra 25 basis points was there only because of a 12B1 trail. And in January of this year, in response to the Department of Labor rule, the industry, literally, the whole industry went through and cleaned out A shares, 12B1 A shares out of advisory platforms. The only way we got away with it really was that we grandfathered Freedom, that we closed Freedom to new assets. So I would just be cautious that unless you have like some really, really significant value proposition, service proposition, something you're doing above and beyond, I would suggest for brand new accounts going forward, pricing at 1 or less. And if you, for your Freedoms, if you want to keep them 125, keep them 125, all under the auspice of just, you know, that's the service paradigm you've been delivering, you're going to continue delivering that. But I would not recommend going 125 on brand new assets.
Okay, thank you.
Great. So Lauren is
Alright.
here from
Hello.
Invesco Power Shares.
What
Question over
what
here.
is the minimal investment to get this started?
$25,000. So we're really glad to have Invesco Power Shares on the platform. This really truly is a unique offering, and as we stand right here today, this offering is really not widespread in the industry. It's really not at other broker-dealers. We're really one of the first firms to come forward and work with a partner to create what we call a smart beta ETF offering, which is combining fundamental weighted indexes with a factor index, low volatility. And Lauren will share more about kind of the intricacies of that, but know that you're really market competitive. To not have any kind of transparent manager fee on here makes this a really great low-cost entry into exchange traded funds. But again, because of the design of it and PowerShare's belief system in the markets, completely shatters and defies a lot of how the industry has looked at plain vanilla ETF portfolios, and this truly adds a lot more value to the individual investor. So Lauren, give it to you.
Alright.
Thank you.
Thank
The
you.
clip is not working,
So just already getting a standing ovation, I guess. Thank you. I'll just go ahead and input now.
No, we're just tired.
Yeah. And then does everyone need like a stand up and stretch break? But good to see some familiar faces here today. I know we've talked about the lifetime investment platform. Some of us one-on-one, some of y'all, this might be our first time talking about it. But I think really the best format is what we're doing today to learn about the platform first. I'm really glad Tracy's here to talk to y'all more about that. And then what my goal will be today is talking more about how we approach our strategic models that are available on the platform. Most of y'all probably already pretty familiar with Invesco as a company and been working with us on the mutual fund side up to this point. But we're really proud of our PowerShares ETF line of business and really glad that we're able to offer this other half of the coin to y'all through the lifetime investment platform. So I'll talk to you more about what that looks like and what we have offering and a little bit of our philosophy. So it's a little bit of what we're going to go through today. I'll try to be mindful of time. If I'm getting short, Tony, just flag me in the back and I'll wrap it up. But first of all, as you know, we do have that strong history of partnership with Primerica, which is why we've been able to develop such finely customized portfolios on this platform for you, because we do have that understanding of how you run your business with our 30 plus years of partnership. And so it's going to be in line with how we run our mutual fund side of things and that same kind of experience that we aim to bring you through the lifetime investment platform. You know, as we both know, both on Forbes 50 most trustworthy financial companies list, both well regarded in the industry. So y'all should be happy to be here, and I'm happy to be at Invesco working with y'all. So a little bit of our timeline and some things I want to highlight as we're introducing this PowerShares ETF side of the business to you. So as you know, A.L. Williams started Primerica back in 1977. Now Primerica. We've both been through a lot of With Invesco, we have a history going back to the 1940s, Primerica going back to 1977. Through that, we really evolved, both of our firms. There's a lot of, mergers, acquisitions, changes, et cetera. So just want to highlight some of those together for you. So 1981, that's when it started investing the difference, right? That's when Primerica entered into the securities business, first working with American Capital, which is now under the Invesco umbrella, and that is also when the Equity and Income Fund happened to turn 20 years old, is when y'all started selling it with American Capital. So just a fun fact and a tidbit there. Fast forward to 1983 is when American Capital started being sold here. 1994 is when American Capital was sold to Van Kampen to form Van Kampen American Capital. Did anyone work with Van Kampen back in the day? Familiar name back there? So then, 2003, on the sidelines here, a small startup ETF firm right outside in the suburbs of Chicago started called PowerShares Capital Management. And they wanted to shake things up in the ETF industry. And we'll talk about what they did there. Well, 2006, Invesco had the foresight. They saw what was happening in the ETF industry. ETF industry really started in 1990. As I mentioned, PowerShares, they came to market in 2003 as they saw the growth in this industry, but saw a better way to approach indexing. It's in line with Invesco's philosophy of providing that superior investor experience, outperforming benchmarks with less risk, etc. And so they acquired PowerShares in 2006 to round out our business, which we had built for so long on the mutual fund side with ETFs that fit that same kind of philosophy. Well then, 2010, that's when Van Kampen Investments became Invesco. Under that Invesco umbrella, we even had a firm called AIM that joined throughout that time period. 2010, Primerica goes public, and that kind of brings us to the decade that we're in today. And we both have now our powerhouse firms. Primerica, one of the fastest growing on the advisor side. Invesco with over $800 billion in assets under management globally. And a large part of that is on the ETF side. And that's where we're seeing some of the fastest growth from an industry standpoint and from a firm standpoint. So here's a little bit about the ETF industry landscape. It's something that's become a lot more relevant in the past decade. You've probably heard about it. You maybe have clients that ask you about it, but up until this point, maybe you haven't had solutions to be able to deliver that to clients. So as I mentioned earlier, 1990, the first ETF came out to market in the early 1990s, and it just tracked the S&P 500. Everyone familiar with the S&P 500? Basically, the most commonly used benchmark for the 500 largest stocks in the U.S. just to get a pulse of what they're doing. And that's the technology we had for indexing back then. It's a very low-cost way to get that market participation, but there was no active management component to that. Well, since that, we have more ETFs that have come to market that track other benchmarks, and then other ways to capture that vehicle with a different indexing approach came. So notice that exponential movement of growth. That's showing back from 2002 up through year-end 2016 of both U.S. and global ETFs. So that's kind of why, remember back in 2006 when Invesco acquired PowerShares, we saw that growth trend, and we thought this is something we want to be a part of, but we don't want to abandon our philosophy in believing in high conviction active management. So now, why this growth? Why do we see such exponential ETF growth? Why are clients asking about it? Why does it account for so much of that volume of trading on the exchange? Well, there are some benefits to the ETF structure that do draw a lot of investors to be asking for them. They can be really attractive for some cases. These are the most common ones. You do have full portfolio transparency, so at any given day, you can pull up an ETF and know 100% of the holdings because at their core ETFs track an index. And you can look up and see what is comprised in that index at any time. They do have targeted exposure, so you can be very selective and intentional about what parts of the market you're playing in because each index is confined and it has quantitative characteristics and screening processes that they use as opposed to a human doing daily trading. Because of that, again, no human doing daily trading, it tracks an index. They are very low cost, and that's probably the number one reason why investors are drawn to them. Whether we know we don't sell on cost, right? But that's probably the why you get the most inbound is because they want the lowest cost investment. And there is some tax advantage to the product design. With mutual funds, you have your year-end capital gains distribution statements. Sometimes you have a client that goes in November and December they have a capital gains distribution that even if they didn't sell out, you don't experience that with an ETF. It's all based on your individual investor's experience. And I'll touch on that more later. But of these, you can really probably, I'd say that the number one is low cost, but portfolio transparency. Does that make sense what I said earlier? ETFs at their core, they track an index. And so if say your client wants to know, do I have this stock in it, or I want to avoid this stock, you can look and see if your ETF has that or not. Low ownership cost is the number one reason, and that's simply because the efficiencies of how they're traded and that it's not an active manager that's trading on a day-to-day basis. They trade on the exchanges just like an individual stock. And it's just, there are some similarities to mutual fund, which we'll talk about, but it's just in a different wrapper. And we talk about the tax advantage fund design. I don't want to go too into this, and especially because it's not like you're buying into individual ETFs, they have to think about this. But the main takeaway of this is because of the way that they're wrapped and exchanged on the exchanges, it's different than a mutual fund. And because of that, your client, they get in day one, they have their individual cost basis, and they will not realize any gains or losses until their individual position is sold. Does that make sense to y'all? So just a little bit different. Same as if you're familiar with individual stocks, and we're back to series, 7 or 6 days, or if you have clients that ever have individual stocks, it's going to be a similar experience to an individual stock, even though it's a basket of securities that you're holding with an ETF. And so I want to talk now about index construction. So a little bit of background of the bones of ETFs. If y'all have questions about that, feel free to ask further, but I want to go to more of the meat of what matters and what makes PowerShares different than a lot of the other ETFs out there, and that's the way that we approach index construction. So I mentioned that PowerShares wanted to shake things up and be innovators in the ETF marketplace. When you think of ETFs, most of us do think of things like tracking the S&P 500, the plain vanilla ETFs like Tracy mentioned, that are tracking benchmarks. Benchmarks are indexes, but you can really make indexes with any kind of different factors or screening process that we want because we have that technology. So PowerShares looked at the traditional index construction that uses market capitalization, and this is how the S&P 500 constructs indexes. They take the company, they take the number of shares outstanding, multiplied by the price per share, and that equals the company's market capitalization. And they weight the constituents of the index by their market capitalization. So if you take something like the S&P 500, for instance, that is taking the 500 highest market cap names in the US, and that's what makes up the index, but furthermore, they weight that by their market capitalization. So some unintended consequences are, you think of a 500 company index, that probably sounds very well diversified, right? It's very broad market exposure. When in reality, you see some heads shaking and you're probably catching on to this, you're weighting by market capitalization, you're gonna have a much higher weighting to those mega cap names like your Apple, your Google, your Facebook, etc. If you look at the top 50 names in that 500 name index, it actually makes up over 50% of the weighting. So if Apple has a bad day, maybe this iPhone X isn't all it's cracked up to be, you're gonna feel it in the S&P 500. Where if it's, say it was an equal weight, all 500 names, for instance, have an equal weighting, you wouldn't feel as much. And I think some investors think it's more like an equal weight, when in reality, there's some really high weighting to those mega cap names. So we're using this as a pulsation of the market, but from an investment strategy standpoint, it's really maybe not the most sound investment strategy if you're planning to hold through a full market cycle. Because market cap is a measurement, not necessarily a factor that has investment merit. So here we show some different hypothetical market cap weightings of companies. from like a company A would be something more like your high cap names like an Apple down to company B, and that would be how they are composed of in the index based on their market capitalization. So this graphic doesn't necessarily matter too much, but does the idea of market cap make sense to y'all and how that is constructed? So that was the standard of when ETFs came to market. So before ETFs, we were using active management. Managers, the way that they add value and outperform benchmarks with less risk is this idea of alpha. So that's the manager's value and what they're providing to outperform the benchmarks. Well, when ETFs came to market, the plain vanilla ETFs, they exposed beta. So does anyone remember that term beta? Basically, it's just the correlation to the market measured like the S&P 500. So how much they move in line with the S&P 500 benchmarks that we track. So you had your alpha, your managers that are trying to look and act differently than the benchmark, and that's how they add value through alpha. And then you have your beta, which is just plain vanilla, broad market exposure for the lowest possible cost. Well, in 2003, when PowerShares took a different approach to indexing, their goal is to play in between those. You can have, you have your active alpha, you have your full market beta, but what if we look at these same factors that active managers are using to outperform and create indexes that screen with those factors? And that's what they did. So you have your active managers, when they choose a company, they look at things like value. They look at things like their dividend growth rate. They look at things like, book value, cash flow. They look at things like volatility, how much that stock is moving up and down. And those are the factors that they consider when they deem something a good investment. We can take that same approach in a quantitative way and screen down from our universe of 500 stocks or 1,000 stocks, whatever the broad market we're looking at. Use quantitative screens to screen for those factors that have investment merit, and those are the indexes that our ETFs track. We do have some broad market throughout the lineup, but the majority of our ETFs are smart beta, and those are the ones that are included in the lifetime investment platform. And this idea of smart beta, some people call it strategic beta, some people call it factor investing. It's that hybrid, it's that in between of full active management and full market exposure. Because we're being strategic, we're being smart about which companies that we want to hold in our portfolios for whatever reason it may be. Whether it's we want only the least volatile names, we want only the highest quality names, we can quantitatively screen down for that. We're able to get some of the same benefits of the low cost ETFs without sacrificing on performance or risk. And that's where PowerShares plays. So it's a different world that we live in now. The industry has evolved as we've had the exponential growth. We've also seen, I would say, even higher growth in this smart beta or strategic beta part of the space, because you have those characteristics of both. And that is one of my favorite things of why we have PowerShares is it doesn't go against, I believe in active management. I think we all believe in active management here, right? Or else, just go get a robo-advisor. Well, we can outperform the benchmark, or we can perform in line with the benchmark with taking less risk and seeing less of those ups and downs. And you can do that with active management or by being intentional about the index construction. And that's what we do. It's all rules-based. And really the goal with smart beta is either to outperform the benchmark or perform in line with less risks to provide that better client experience and to ultimately to be more strategic about how you get to your clients' goals. And these work best when held through full market cycles. Something to think about, Invesco, we're a strategic manager. Tracy talked a little about strategic and tactical. So there's a reason that we have smart beta in a strategic manager format is because they are meant to outperform or perform in line with less risk over full cycles. We're not trying to time the market here, we're just trying to be intentional about our exposure, just like active managers do in a different way. So we do have some benefits with PowerShares because we were one of the pioneers in what is now known as smart beta. We have the highest number of smart beta strategies. We're the second largest provider. So if you look at the ETF market overall, we're the fourth largest in AUM of just ETFs. We're the second largest if you're looking at that smart beta space. We have the most number, or the broadest lineup of smart beta ETFs. You can see in the second we have 94 different smart beta ETFs. Don't worry, you don't have to know about all of those, but just know that we have a lot, and that's what we're working with on this platform. We have the most that have a 5-year or more track record. So you can see that the orange is PowerShares and the industry remainder is the purple. And then we also have the most with over 500 million in assets under management. So this is really our wheelhouse. We are leaders in smart beta. That's what we're going to be known for, and that's where we've put our intention in developing strategies. So we like to be known as a company of first and being kind of a top provider of smart beta. And as I mentioned, it really differ from what we aim to do on the actively managed mutual fund side. It's providing that superior client experience, outperforming with less risk. And some of our accolades that we've received, I already mentioned some of these that are showing our depth and breadth and longevity of our lineup. But we've also received a lot of recognition and awards just in the PowerShare space for being innovators. We were a 5-time Morningstar ETF category winner, 6 global ETF awards. All in all, we have 32 different accolades from the industry for the achievement of being innovators and also delivering on what we say we are going to do. So are y'all tracking with me so far, kind of getting what this is about? Now what I want to go to is a little bit more about what's actually offered on the platform. So you know what PowerShares and Invesco stand for. We take this idea of factor-based investing. And I like this quote from our managing director with PowerShares about this idea of factor-based investing. What are factors? Well, we all know what DNA and genetics are, right? And how they play a role in our bodies. So he compares it to that. So factors can be viewed as the DNA of an investment portfolio. Like DNA, they carry certain traits and behaviors. When combined, they can act as the genetic code of a diversified portfolio. So I like to kind of think of that, it's how the factors will determine how the stocks will behave in different environments, and working together, they will keep the body running how they are. And don't worry though, it's not our job to put the genetic code together and figure it out. We have a team of CFAs that do that, but they're looking at it from this factor perspective as opposed to just the broad market perspective. And from that 94 plus lineup of ETFs, our team, it's the Global Solutions team, which I'll talk to you a little bit more about, are the ones that actually manage the 6 model portfolios that include our PowerShares ETFs on the platform. But they've chosen 2 lines of ETFs that take different factors into their index construction because of the way that they play together. So I'll talk to you a little bit about what those are and why they chose them together. But it's low volatility and fundamentally weighted. And in the low volatility and the fundamentally weighted, you have everything from your U.S. large cap, international large cap, all the way down to your U.S. and international small cap, everything in between. So for low volatility, an example of that will show is our S&P 500 low volatility portfolio. But I like this infographic that shows how simple it is to take a different approach to indexing and what that looks like. And I'll talk to you about the benefits of that. But for example, just take the S&P 500 that we all know, right? Screen down to just the 20% least volatile stocks from that index. So think of it as like you're sifting flour. So only some of that sifts through there, just the 20% least volatile stocks. How do they measure that? They look at standard deviation over the last 12 months. So they have a number. They're not just saying this looks like the least volatile. Then, instead of weighting by market cap, which we talked about earlier, they actually inversely weight by that same factor, volatility. So you're going to have the highest weighting to the least volatile and so on and so forth. And that is your S&P 500 low volatility index. And that is one of the indexes that is tracked in our portfolio. And it's as simple and straightforward as that on the low volatility side. The other side is our fundamentally weighted. Whereas instead of looking at that one factor of low volatility, I'll show you what the benefits of that. They're looking at 4 different fundamental factors. And again, these probably look very similar to maybe some of the fact sheets of funds that you're using of what managers look for. But it's screening and weighting by sales, cash flow, book value, and dividends. and we'll talk to you about, again, why we like those. But these are the two lines. You can take a picture, but don't worry, we're gonna take a little deeper dive into each of those. This is our low volatility. So why do we want low volatility? So I mentioned we weight by factors that have investment merit, but why does this work and what does this look like in practice? Well, we all know, I show you an example here of 3 hypothetical portfolios that don't exist, but we're looking at all 3 have an average annual return of 5%. However, portfolio A has a hypothetical volatility or standard deviation of 0%. This is the investment that all of our clients ask for that doesn't exist, right? I want 0%, I want 0 ups and downs with guaranteed 5%. Well, I'm sorry to say that doesn't exist, and we are not delivering that in the portfolio. We do have portfolio B that has 11% hypothetical volatility, which is a little bit more realistic, right? And then we have portfolio C that has a hypothetical volatility of 27%. So we have our 0 to up to 27. Well, if I didn't have this graphic, you would think an average annual of 5%, but all 3 portfolios started at $10,000. How many of you would think that you would end with the same amount of money? It sounds like, right? Okay, there's 3 options. You start with $10,000. Average annual at 5%, you should probably end with the same ending amount, right? Well, in reality, there's this concept called volatility drag. So basically, the 0 volatility ends up with $13,401. 11% you would have had $13,040, and the 27% you would have only had $11,249 at the end of this 6-year period, because for every time you have that drag down, it's not just make that same amount up. You have to actually make up significantly more just to get back to break even and have the growth that you would have had in this 0% volatility range. So the effects of the ups and downs can have a drag on your portfolio's performance, which is a little bit more than just looking at average annual performance. So if we can avoid these outliers on the up and down side, we can minimize that drag on the portfolio that volatility can have. And we can do that just by screening to only those stocks that have the lowest volatility from the index, and just using those quantitative screening process. Does that make sense to y'all of why we like volatility as a factor? So it does a good job just explaining why. And I mentioned earlier as an example the S&P 500 low volatility portfolio, because it's one that we can probably most easily relate to, starting with the S&P 500. This one had an inception date of 2011, and I talked to you about the screening process for that. But we have this across basically any asset class, domestic or U.S. equities that you want. We have that same kind of approach to indexing, and they'll be included in the portfolios. So that's one half of the coin. And the low volatility, one thing to keep in mind with low volatility is that the goal is not to be, oh, how does this work? I'm just not going to go back. Okay. The goal is not to be the number one in a bull market, or in that really rising equity market. The goal is not necessarily to be at the top of that peak, because you're also likely to be the one at the bottom of the peak the next year. It's to be that more smooth ride, lower drag, consistent performer for your clients. Fundamentally weighted takes a little bit of a different approach and will work in different environments. Just like we talked about, just like the factors work in different environments, genetics express themselves in different ways. And I like this quote to explain fundamental weighting. So we have a graphic at the top of market cap, traditional kind of Wall Street indexing versus what we like to call Main Street indexing, which takes into account these 4 different fundamental factors. And we use measures that represent the overall economy. So not security prices, which are moved by fads, bubbles, crashes, and shifting expectations of the markets, but by using measures such as 5-year averages of sales, cash flow, dividends, and book value, the fundamental index approach, unlike traditional market cap weighted index funds, sells the most popular and trendy stocks while buying shunned and neglected companies. So think of that. When indexing approach, it sells the most popular and trendy stocks while buying shunned and neglected companies. How many of our clients would probably do that on their own? right? That they wouldn't. And it's hard to convince them to do that, but it's an approach that works, and this is how we should approach investing, selling on the bubbles and buying on the dips. And that's exactly what this indexing approach does in a quantitative way. It takes the human element out of that, and I'll show you how that can play out in practice. One that we're showing an example of here is our FTSE RAFI US 1000 portfolio. So this would be the most comparable to the S&P 500, primarily large cap names here. And you don't have to remember all that blah, 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 blah. If you want to just go down, it's PRF, or we can call it RAFI instead of having to say FTSE RAFI. But, so we have our RAFI US 1000, we have our S&P 500, and our S&P 500 financial sector, so a subsector of that. And I like to show this chart because it'll show in one of the roughest times in the stock market, remember the global financial crisis back in 2008, how each of these indexing approaches worked, and some of the benefits of this opportunistic weighting method using those 4 fundamental factors. So in that March 31st, 2008 to March 31st, 2009, that's when we felt that really, if anyone was invested or was in the business time, a lot of rough phone calls. I mean, the S&P 500 was down almost 40%, 38.6%, and it was largely driven by this financial sector, which was down 63%, which made up a significant portion of the S&P 500 at that time. Well, the RAFI US 1000 was down 42.7% in that same time period. So it was down more than the S&P 500, but it definitely wasn't down as much as just the financials, right? Well, in that recovery period from March 2009 through the end of 2009, S&P 500 rebounded. It was at 41.4%. Financials really rebounded at 64.7%. But RAFI rebounded almost just as much as the pure financials index at 64.9%. So you're kind of looking at the numbers here. We'll fast forward to the full cycle. So we had that tough downside and that pretty nice upside. Well, through that full cycle, which again was a really tough period for investors, the RAFI, even though it was down more than the S&P 500, was only down through the full cycle by about 5.5%. S&P 500, 41% up, but you're still down 13% through that time period. And the financials had a rough go. They were still through that full cycle down almost 40%, even though they had almost a 65% run up. Again, that volatility drive. So it shows, I just like to show this as an experience of one of the ETFs that's in there, that it's not always going to be the smoothest ride like a low volatility. Sometimes they may go down more than the S&P 500, but they also tend to participate more in recovery, so they're more opportunistic with how they buy, and they tend to just perform in different environments. So they chose the low volatility and the fundamental weighting because they behave differently, they play different roles, and they tend to work better at different times. So it's another layer of diversification than what we traditionally think of as, stocks and bonds only. And that's a little bit more about that. The PRF, the US 1000 that I showed in this example, primarily large cap, but again, we have this in international, small, and mid, which are included to fill out the equity portions in these portfolios on lifetime investment. And note that these are all just examples of the ETFs that are in there. So now I'm going to talk to you about what is the actual package solution that is available through lifetime investment that includes these strategies. Well, they're based on, there are 3 things I want you to think of here. They're needs-based, they're outcome-oriented, and focused around clients' goals, and they're developed specifically for delivery to Primerica on this platform. So they're based on your client's risk profile. So you go through your risk profiling questionnaire, you come out, they're conservative, moderate growth, and we have portfolios that are designed to fit each of those needs, and even all income oriented, all equity oriented, etc. So try to basically cover all the bases from your strategic balance to all income to all equity that are customized to fit your client's goals and experiences. And this is the team that they're run by. So I like to say it's our team of CFAs that sit behind the desk crunching numbers all day. But their goal is to come up with risk-based, goal-oriented portfolios. So they're looking at kind of the efficient frontier of, we have all these 94 plus strategies available to us. We know that your client's goals are based on this, and this is the level of risk that they can stomach to get there. So they're looking at what is the best strategic allocation from this lineup of funds that we have that'll get them the highest likelihood to achieve those goals with the lowest amount of risk. And that's what they do. So we have their bios and pictures and experiences in the brochures that are available for your clients. So you don't have to remember all of that, but just know that these are the people that are behind the hood. And they not only manage the portfolios for Lifetime Investment Platform, but they also manage all of our allocation funds, which happen to include both Invesco mutual funds and PowerShares ETFs. They manage our $7 billion plus 529 plan that we went over from the state of Rhode Island, which includes mutual funds and ETFs. Our income allocation fund, if anyone of y'all are familiar, basically all of our allocation strategies that have targeted risk and basically risk allocations, that's what they run. So their experience lends itself well to this kind of platform. So we have 6 different portfolios that are available. 3 of them are balanced. You can think of those as they can be one ticket solutions that include both your equity and your fixed income. We also have all equity strategies, which are the equity carve-outs of those conservative, moderate, and growth strategic balance portfolios. And then we have a smart beta income portfolio for your clients that are looking for that current income. They're going to have an expanded fixed income selection on the ETF side. And here's a little bit more about the allocation. So your conservative is going to be your 40-60 equity to fixed income. Moderate is going to be your traditional 60-40. And then growth is going to be, generally your 80-20. And these are the allocations even further broken down by, U.S., large, mid, and small, international developed, international emerging markets, and fixed income. And we are a strategic manager. So these are the set allocations. This is what they have determined is going to get them on that efficient frontier of the highest likelihood of achieving their needs based on their risk tolerance with the level of risk that they can stomach. And they're going to be fully invested in these allocations at all times. They're meant to perform over full cycles. So we're not taking any bets on short-term movements in rates or markets or anything like that. We're just looking at, based off the historical behavior of these asset classes, historical risk contribution, and the way these different factors perform, this is the ideal asset mix. And they'll make sure that the portfolio is rebalanced to the strategic allocation so your clients stay on that path. Something that does not happen for the most part when you go into a mutual fund portfolio when you're setting your own allocations, right? So that's one of the benefits that I like about the platform for really any is that you have someone that's constantly rebalancing and getting them to those allocations that are in line with their risk tolerance and needs. We also have all equity carve-outs. So say you have a client that's more equity focused, or maybe they have fixed income assets elsewhere and this is just the equity portion. We have a global and a US all equity portfolio. And note that these are the asset classes, but for each of these it's going to be split between that low volatility and fundamental weighting as far as the ETFs go. And then the income allocation portfolio, that's going to be a little bit, it's going to have some of the same fixed income ETFs, but an expanded universe of fixed income ETFs in there that are maybe will have your global and your alternative fixed income all in one to get you that more diversified fixed income exposure for your income-oriented clients. So no equity included in that one. So that's a lot of information to cover, a lot of things to think about. We also have a lot of resources that are available to you on POL, and I can email out to y'all to have on hand. But we have the orange piece. We'll talk to you a little bit more about ETFs if you want to read more about the structure, want to talk to clients about it. We have on POL, you can get us, become ETF experts. We have videos, seminars, webinars, etc. ETF University, all you can imagine. We have specific to the model portfolios, a 2-pager, as well as my favorite piece is we're actually working on updating an even enhanced version, but for all of y'all that I've talked to, I've given y'all the client brochure, and that's my favorite piece that'll go through the most in-depth. But I would say after this, get on KOL, go play with the resources, be on the lookout for our updated client brochure that will get out to y'all. And if you want me to send you an email with any information or anything like that, you can let me know. But we make sure to have them on hand here. So like Tony, you probably have some
Oh, yeah.
in the back there, etc. Make sure y'all are well stocked. And remember Invesco, the difference. We have to add some orange in there now, some orange with the blue. But do y'all have any questions? Did that give you some things to think about, some clearer insights into what we have available on the platform? All right. So again, a lot of information today, but hopefully it's just every time it's kind of chipping away at making it more and more clear. But you have all the resources available through Primerica, and so try to make it as easy as possible. But,
All right,
all
awesome.
right, thank you.
So, this story is my way to illustrate, again, what the lifetime investment platform provides. Because sometimes this is good, making money faster. Sometimes this is good because when things don't go well, you don't kill the dog, you don't get killed, right? So really what this is, I labeled this as Invesco.
We don't kill dogs.
They get a cat and she's
They get a
in.
snake.
I'm still invested.
Big
I like dogs though.
It's the only thing that might need to be fine-tuned. Here's the point. Again, when we weren't talking about the dog, we wanted to go 80 miles an hour and make money faster. Okay? And that's what a strategic investment does. It gets the highest highs, but it also will see some downturn. Well, what Invesco brings to the table is more of a strategic driver, or car, if you will, because they're investing in ETFs, and we just talked about that. ETFs are lower cost in general. Low volatility investments are what they use, and you heard terms like factor, I get it wrong, factor indexed or
Factor-based or
Factor-based.
strategic beta or smart beta.
smart beta, those types of things. So what that means is normally you're investing, passive investing makes sense when you're investing in things that you kind of know what's going to happen. So like large, stable companies, you know that if something bad really happens, that P&G is going to continue to put shampoo in bottles, and Duke Electric will continue to provide electricity. You'll turn your light switch on, right? Things keep going. So that's where passive investments can make sense. The active side is where we would use Meter. Okay, because what Meter does is more tactical, and they invest in mutual funds, but they are defensive mutual funds. And you'll see that in their literature. And what that's designed to do is to avoid this downside. Doesn't mean they won't go down, but in theory, they don't go down as much. So you don't have to recover as much. This is traditionally going to be small, medium-sized companies, or maybe even international companies, because those are more, typically take more oversight to make the right changes with them as you go. They're not as predictable. So one of the things you have in your Meter packet is this page. You guys can dig this out. This page right here is one of the coolest sales tools we have, because this tells a story that proves this story. Okay? What you're investing in, again, with the Invesco side, with strategic, it's gonna win for you long term, but it's gonna constantly stay invested. The meter side, you're giving them the ability to say, we don't like what we see, and then they can take some of, up to all of your money, all your investment, and put it into cash. Okay, so this, does everybody have this? So let's go to the back side that has 2007, 2011 on it. So what it shows, what I want you to highlight or focus on are the red boxes. That stands for cash and cash equivalents. So you can see in 2007, what this represents are quarters, so 4 quarters per year. In 2007, how much did Meter have in cash or cash equivalent? Everybody say 0? You see that? Okay, what happened in 2008? Everybody remember?
Oh, yeah.
Got ugly, right? Okay, got really ugly. So if you went back and looked at it, from the beginning of '08 to the end of the first quarter of '09, the market went down about, S&P went down about 40%. So, but look, here's what happened. Meter saw it coming, or made the decision to put, they went from 0% in cash to 35% in cash. Mr. and Mrs. Client, would you be happy if your investment company saw a challenge coming and adjusted your investments to save you money? Okay, the next quarter, they went down to 25%, then 25 and 30, all the way up to 50% in 2009 first quarter. And if you don't remember this, the end of the first quarter was basically the low point in the market. But then look what happened, okay? That was cash. Next quarter, they took it down to 20%, and they started to reinvest in the market. Now, what were most people doing after they lost 40%? It's gone, right? They're pulling it out. Why are they pulling it out? They're afraid, and they don't know what they're doing, and they don't have you. That's why. Okay? If any of you are around during that period, you know we got phone calls, and it was our job to help coach people. Something like this shows you that this investment company that has this piece of the investment is doing that for you. So what that means to you is your client's not seeing a 40% decrease. Now they're still seeing a decrease, but not as much, which gives you time to maybe help them hang in there and not make a mistake. Because if somebody got out April 1 of 2009, from there to today, from there to last Friday, it's almost a 300% gain. They left that on the table because they didn't know what they were doing and they didn't have anybody to help. Okay, so this type of company, a tactical company, makes those decisions. Now, how many of us in this room saw 2008 coming? If you did, you shouldn't be sitting in this room. You should have made a fortune, and you're going to go. So, what this does, this whole page just shows 10 years of asset allocation. You can look at a couple of other periods as late as 2015. Third quarter, fourth quarter, Meter went to 45 and 40% in cash because the market had downturned again. So this is where you combine active management with strategic management, and by putting them together, you get the best of both worlds. Okay? So this to me was a very helpful chart, and it's one where I can basically show the client we're investing your money with a company that's watching what's going on and will make some decisions on the best thing to do with your money versus, as Tracy mentioned, and she's absolutely right, all we've ever really taught our clients is buy and hold with a Fab 5 or a Fab 3 or something like that. This takes it to a whole other level. And it's more sophisticated, and it's going to give you the chance to write a lot bigger tickets with your clients. Okay? This is simply how I explained the lifetime investment portfolio platform. Then you run a proposal, which will disclose the fee structure. We'll also disclose their portfolio, what they risk level, okay? Moderate growth, aggressive growth, whatever it is. You'll ask them questions through the proposal, it will tell you exactly what to put them in. And when you do the proposal, it will give you not 500 blends, but probably 8 to 10. And what we're doing in our office is we are using Invesco and we're using Meter. Because that's the story that makes sense to me. Neither one of these companies are taking a management fee. It's 0. So that makes your fees even lower. And I just love these stories. Okay, we've invested with Invesco forever in our day shop. They've won. We have lots of people that have invested with Invesco, and you know they're retiring now. They're good. They won. So that's a great piece. This piece though helps people be a little more tactful about it, so you can try to avoid those downturns. Okay. So you do your proposal, and then it's just a matter of writing the account. Okay.
Bill, are you setting a fee for your services for those clients?
Yeah, same as everybody else, we all have the advisor fee. As Tracy mentioned, you can adjust that between 0.8 and 1.25. It's up to you, based on volume and what kind of value you think you bring to the table. But quite frankly, and it's probably true for most of you in here too that have investment clients, what do your investment clients do? Pretty much do what you tell them to do, right? And that's not meant to be pompous, but so, you know, I want you to understand it too, but if you could explain this in some manner, and if you got a better way than that, I'm all ears. That's really, haven't been doing that too often, but it has connected with the clients in a way that they kind of get it. And they might have a question or two, which you know, you do have to work at this. Okay, you gotta work at understanding this, and understanding the key points and the highlights. But you know, most of your clients are gonna do what you tell them to do. What I want you to feel comfortable with is what you're telling them to do is the best product in the industry. I have no doubt about that. Okay, and hopefully you're getting that belief in what you're seeing tonight, even though you may not understand it all. You know, get on conference calls with some of these fund managers. Every time I do a conference call with a fund manager, like halfway through, I'm like, I have no flipping clue what he's talking about. But he's one smart cookie, right? I don't need to be the smartest person in the room, right? I need to be the person that connects people like Tracy and people like Lauren and people like Andy and all those managers. That's all you're doing. You're hiring those people. So you deserve to get paid that fee. And remember this, you're bringing it to middle income America. No one else is doing that. $50,000 or $25,000 is the minimum. You guys got to understand what you got your arms around, okay? So hopefully that helps. If it didn't, I apologize, but that's no shot.
All right, Andy's coming up here. Talk about Meter. I don't think you could have gotten a better introduction from Phil.
I'm done.
You're done? Would everybody take a picture of this? I took a picture of this. I think we might turn it into a great sales idea, client acquisition idea. For
Change
you,
the
but-
dog, please.
Deer, just use deer.
Maybe Powell.
Keyword rep. You just repped the dog a little bit. You didn't-
For Canada, use a moose.
That was adopted by the child.
Down in front.
You can have Lauren come up here and pose with Andy with her car.
You're on the dead dog side now, that's not my side.
Wait. I didn't fix this. There we go.
Here, you want this? A deer?
Killer.
Deer.
Deer.
There we go.
Side.
Better.
Is everybody good? Can we erase?
I fixed it now.
Wait, no, just kidding.
Good.
Don't make it.
Yeah. I was like, oh, you want to kill a dog?
Yeah, just.
See, you can make it believable. An elephant walk down the road.
How's everybody doing?
Oh.
Long day, it's Monday. Monday Night Football's getting ready to start.
Yeah. Yeah.
So, like Tracy said, my name is Andy Barton. I am actually not the representative for you. He's actually my boss, Justin Turman. I think a lot of you have probably met him before. Had a freak accident today. His wife's actually a painter, and she was painting a wood pallet, and it fell like through her foot. So she like tore some cartilage, broke some bones. So yeah. So he is apologizing he can't be here, but priorities, right? So Phil stole most of my thunder already from the packet I was going to go over, but I am going to touch base a little bit on who Meter is, how you can access us through the new platform, and then answer any questions that you guys have. Is there anything you definitely want me to talk about in the next 25 minutes? Any questions before I get rolling? No? Okay. So,
You have a mutual fund comparable platform?
correct, we are mutual funds.
I mean, municipal bond.
No, we do not, but I'll get into that in a second. That's a good question. I'll definitely touch base on our fixed income.
Maybe performance.
Okay, yep, we can do that too. Anything else? So fixed income performance, okay. So there is a PowerPoint for this, but I'm more of a drawing person myself, and Phil's actually a better artist than I am, so forgive me for what you're gonna see. And the last time I spoke was last Thursday, I believe, and I had to start my presentation with a 30-second dance-off. And I am a worse dancer than drawer, and you're gonna see how bad I am at drawing here in a second, so be happy it's this and not my dance moves. Meter has a very, very similar background as Primerica. So let me tell you about how Meter got its start in 1974. We were founded by Bob Meter Sr. Before he founded Meter Investment Management, he was a school teacher and a basketball and a football coach. So, sounds a lot like Art Williams, right? As a teacher, he wanted to get some financial advice. His wife was a housewife, and they didn't have a whole lot to invest. And he couldn't find somebody to help him. He couldn't get good advice. So he said, wait, there's got to be a better way for me to get advice. So he founded Meter Investment in 1974. And the company is run today by his son, Bob Meter Sr. So been around since 1974. That means we've been through every type of market imaginable. Nobody in this room's been in the business since 74, right? Who's the longest? And I pass out gift cards to Starbucks too for morning coffee to winners and stuff. 22? Can anybody beat 22?
I can lie.
You said you could lie?
94 is when I started.
I'm not good at math. 22 longer than that?
Beverly's a pioneer.
Yeah. 3-0.
She's only 20 minutes.
Well, you gotta share the coffee now.
She was 4.
So since 74, we've seen just about every type of market imaginable, right? We've seen inflationary periods and really good times in the market, like the late 90s and the early 2000s. We've seen deflationary periods. We've seen even periods of stagflation. And just in the last 15 years, I think a lot of us were in the business for the last 15 years, had the dot-com bubble of 2000, 2001, where your clients might have lost 25, 30%. And then in 2008, you had the housing crisis and recession. This is what Phil was talking about. These are when you get the phone calls, right? Well, it's nice if you have an answer better than, we're gonna stick it out. We're gonna buy and hold. You told me you could take this much risk. Yes, your portfolio that was 25,000 is now worth 12,000, but we're not gonna change our course, right? Well, that's where Meter steps in. That's where a tactical manager steps in. And also, like Phil mentioned, I'm sure Tracy will too, we pair very, very well with a strategic manager like Invesco. And I know we've all preached this already, and are you going to talk about fees here in a second, Tracy? Okay. There's two money managers that do not charge that additional asset manager fee of up to 25 basis points, and us and Invesco are the two that charge 0 in that space. The reason we can do that is we also have proprietary family of mutual funds. So we offer Primerica 4 portfolios, but what goes inside those portfolios are our proprietary mutual funds. So there's a fund expense in a mutual fund, right? That's how those managers get paid. Well, that's how we get paid at Meter. So we don't add an additional fee on top of that to put it inside a portfolio. Now, before I was here today, who had heard of Meter in the past? A few? Okay. So one of the nicest things is we're headquartered in Columbus, Ohio. So I drove down here. It took me about an hour and 10 minutes from office to office. So we're local, and we have an open door. Tracy was just in our office last week. If you have a question, we have the smart people that sit in their own section of the office, and you are more than happy to have a conversation with them. You can come and tour the building, you can have a webinar, have a one-on-one with your investment consultants, but we're also just an hour away. So if you want to see the nitty-gritty and see how everything works, you are absolutely to come by whenever you would like. And we manage just over $13 billion in assets. So we're not a small mom and pop shop, but we're not as big as some of the other firms that you've heard of in the past as well. So I'm going to go over how we manage money and really the best way to use us and kind of piggyback on what Phil was just saying. On the platform at Primerica, we have 4 portfolios. And these are all inside the white packet that you guys have sitting in front. Now, from now on, it's going to be IOUs on gift cards, because I didn't think I was coming to this until about 1 o'clock today. And I'll get you a gift card. So, inside of these portfolios, again, these are constructed of our mutual funds, right? So we control what goes inside of this. Now, the nice thing is, what is inside of these portfolios will change based on what the markets are doing. That's the tactical allocation sheet that Phil was just talking about. That shows you how we react to what is going on in the market. And just like Invesco, we are very quantitative and rules-driven as well. There are about 15 people on our investment team that are CMTs, CMAs, the really, really smart ones that sit in a room all day long with like 8 TVs and 6 computer screens and don't get out much, right? And I'm glad they're on our side. We have them. But they really don't have a say in what we invest in. They just process the data for our models. So very, very factor and quantitatively driven. Okay? Now, there are 3 common investment disciplines that money managers use. Anybody want to take a shot at naming one of them?
Who's the question again?
The 3 types of investment disciplines.
Buy and hold?
Okay, so that's similar. So what I'm looking for here is, anybody heard the term bottom-up analysis or top-down analysis or trends and technicals? Okay, so bottom-up analysis is an investment discipline that focuses on the company itself. So when you hear terms like PE ratio, that's bottom-up analysis. That is more fundamentals and sentiment-based. So you're focusing on the company. So what is Apple doing? Who is Apple's CEO? Are they coming up with the next great iPhone? That's bottom-up analysis. Then there's top-down analysis. So think the complete opposite. You don't care about what's happening at Apple or the bottom. You're more focused on the top. So what's going on in Washington, D.C.? What is Janet Yellen, the chairwoman of the Fed, saying? What are interest rates doing? It's more macro or big picture. And the last one is trends and technicals. Have we heard the term 5-day moving average? Resistance and support? Some people might actually call this market timing as well. That's trends and technicals. That's usually the name that is given to an active manager. But at Meter, do we use trends and technicals? Yes. But we equally use bottom up, top down, and trends and technical factors. So there is a lot that goes into this, and it's scored every single day. So these 15 guys on our investment team have a lot on their plate that they are looking at every day. But what they come up with are these 4 portfolios that you have available on the platform. The first portfolio is our growth portfolio. This portfolio, if the market looks good, can be 100% invested in stocks or equities. So a pretty aggressive portfolio. But what Phil just showed you on the 10-year chart is this portfolio. So you can tell it's going to change based on what the markets are doing, right? We saw here in 2008, we actually had up to 65% in cash in the middle of a quarter. In 2015, 2016, we had 42% sitting in cash in this portfolio right here. So when you see this equity line, think about this is the most amount of stock that can be inside that portfolio. Everybody's following me so far? Mm-hmm. So if it can be all stock, what's the minimum amount of fixed income that can be inside of this? We only have 100% of the pie to pass out, right? So this can be down to 0 right here. And it can range anywhere in between. Everybody with me?
Yep.
Perfect. Now the next step down is our moderate growth portfolio. The moderate growth portfolio has a maximum equity exposure of 70%. So what's the minimum amount of fixed income that's going to be inside this portfolio? 30, right? But now here's where things get tricky. And this is going to be a gift card one. We need a business card so I can get it to you. When we look at that 10-year chart, and it says that Meter has a 50% equity position. Okay? So we have 50% of the maximum. What will this portfolio look like right here? How much will be in the moderate growth portfolio? 35. Because you take 50% of the maximum of 70, right?
Yeah.
So, this is the color, we've got 35% here. Now, what's the minimum amount of fixed income? 30, right? But if we add these two together, what are we at? We're only at 65% of the portfolio, right? So we still have 35% left. Where is that going to go? It can go to one of two places. It can go to cash, or it can go to fixed income. This is a minimum amount of fixed income inside that portfolio. Everybody got me? If we can explain this to clients, we're on a very, very good start. Our next step down is our moderate conservative portfolio that maximizes out at 50% equity. So the minimum is 50% in fixed income. And then our most conservative portfolio has a maximum of 30 and a minimum of 70% in fixed income. Everybody with me? Perfect. So now the next question is, okay, I understand this is a maximum. But how in the world do you figure out how much you're going to have in there at any given point in time, right? That's the question. So, what we do, our investment process is broken down into 3 W's. The first W is the why. And this is where we decide how much equity exposure we're going to have inside your portfolio. Now, how do we do this? Those really smart guys on our investment team compare over 220 factors on a daily basis. Don't ask me what they are or how they do it, because I don't even know, right? But they're scored on a daily basis. There's 2 different models, a long-term model and a short-term model. The long-term model and short-term model are scored on this heat map, which is one of the one-page inserts inside of your white packet. This is updated weekly on the POL for you. You can see here the long-term model and the short-term model. Where they intersect is how much equity exposure we are willing to take on at any given point in time. In other words, let's say this. Let's say of all the 220 factors, we run the numbers for today. Let's just pick one. Let's say the PE ratio of Apple is 25. We run it tomorrow, and the PE ratio of Apple is 26, right? That's one better, so that's going to be one step over. Everybody following me? If it was worse, it'd be one step in the other direction. We do this for all 220 of our factors, and where we intersect on this heat map is how much exposure we are willing to take on. So you can see here the dot, as of the close of business last Friday, this is last week's chart, was hovering right between the orange and the green. Everybody see that? So we are not 100% allocated in equities right now. We are at 92%. And on my drive down here today, we got the updated one, and we are still at 92%. So not much changed from last week to this week. But 92 is a pretty good number, right? The market looks pretty strong right now. We are in one of the longest bull markets in history since the low of March 9th, 2009, right? Your clients are pretty happy with what they have seen on their statements. But it's also a law of averages, right? There's an average for a reason, right? Whether you go 5, 5, 5, 5, 5 and average 5, or 0, 10, 0, 10, 0, 10, we're still averaging 5, right? But that average is there. So I'm not saying we're due for a correction tomorrow, next week, next month. If we thought that, based on our rules, we would not be at 92%. So we're still optimistic on this market, but no, this could change next week. Now, when it changes, it doesn't make wholesale changes. We're not going to be 92% today and then jump to 50% next week or tomorrow. Just in the last 6 weeks, we've gone from 100 down to 88 up to 92, but it's taken 6 weeks to make a movement of 8%. So we're not trying to time the market. We are just immediately reacting to what is going on and scoring all of those factors. So that's, yes?
So that, it just uses the 92, that applies to all of the allocations?
All of them, correct.
So it's 92% of 70 and 90, okay.
Absolutely correct. I use 50 because it's easier math up here, but 92 is what I should have used. So that's the why. How much equity exposure we are going to take on. We're at 92%. Okay. So where are we going to invest that 92%, right? There's a lot of different choices out there. So we run the factors again. And this is where we decide, first and foremost, are we going to be focused in the US or are we going to be focused internationally? This is also on the back of this investment view sheet. This is why I really like this, and it comes out again on Monday afternoons It gives you some great, easy talking points with your clients. So if that person that's got a meter portfolio calls you on the phone and says, hey, what's going on in that account? You can say, oh, and you can pull this out real quick, and you can say, oh, we're focused 92% in the equity market. Of that, on the back page here, 93% of that is in the US equity market, 7% international. We're focused a little overweight on small cap and a little underweight on large cap. Does everybody see where I got that from? Okay, so here we're going to decide US or international. What's doing the best right now? Large, mid, or small companies? Growth or value companies? Where is the best value for your client right now? And then we go one step farther and we choose the top sectors. So financials, consumer discretionary, consumer staples. What is the best place to have your client money right now? And then we go one step further and run about 110 more factors, and we decide what to invest in. What individual companies to invest in. Inside our mutual funds, we can choose individual stocks, we can choose mutual funds, and we can choose other company ETFs as well to put inside our mutual funds. And then again, we take our mutual funds and put them inside our 4 portfolios. That's the equity, our defensive equity strategy. That's what we're known for. That's what's been around since 1974. Yes?
So did you say it comes out weekly or it comes out daily with that sheet?
The sheet is updated on a weekly basis, but these models are scored on a daily basis. Good question. So that's the green portion you see inside your packets. Inside this white packet right here, that's our defensive equity strategy. This packet goes into a lot more detail on the holdings inside the portfolios, the top 10 holdings, equity, and fixed income. We have just been over the equity side, or the green portion. But the fixed income side is done on a very similar basis. So, we've talked about how we tactically manage equities. We tactically manage fixed income on the same basis. It's multi-factor. There's multiple disciplines that go inside of this. And we can change what kind of fixed income we're invested in. Where are interest rates right now with inflation? They're low, right? So right now, let's say you can get a bond paying 3%. If interest rates and inflation go up over the next 2 years, and all of a sudden you can get a bond paying 5%, if you got a bond paying 3, and I can go buy a new bond paying 5, why would I buy yours? I wouldn't, right? So that's why it's important to have flexibility in what kind of fixed income products you're buying right now. It's great to go to the bank right now and get a 30-year mortgage on a house. Because you're dirt cheap interest rate. It's not great if you're a saver and want to go to the bank and park it in a 5-year CD or a fixed annuity or whatever it is, right? Not such a great number. So you got to have flexibility. And that's what our tactical management inside our fixed income does. We can change the length or duration of the bonds that we're invested in. We can change the credit quality too. There might be a time where our fixed income is focused on U.S. government short-term bonds. Govies, TIPS, treasuries, right? Or we could have a slight tilt to emerging markets focus. We've heard the term junk bonds, right? High yield bonds. Now we have maximums we can put inside of that, but we can move our fixed income portions that way if the risk is there and the reward is there for that risk we're going to take on. But it's constantly changing what we are invested in on that daily basis. So like Phil said, we have a driver that can adapt to what the market is doing. And I want to get into our Why Tactical brochure for about 2 minutes and talk about a couple of topics on here for your client. This entire brochure is client approved. Before I flip from this, are there any questions on how we manage money? I know it's a lot. It's a lot packed into a half hour. But any questions?
No.
All right. So, one of my favorite pages is the one that Phil's already been over, the tactical allocation shifts over the last 10 years. And inside this brochure, on page 3, in the bottom right, there is a market declines of 5% or more chart. There have been 17 pullbacks of over 5% during this bull market. So yes, the market has done very well since the bottom in March of 2009, but it hasn't always been pretty. I'm sure you've gotten phone calls, right? Saying, hey, my last statement said 100, this one says 90. What happened? This chart is what leads clients to make emotional and rash decisions. Once a client loses 10%, it might be a phone call to you. Once they lose 20%, they might go see another advisor and get a proposal. Once they lose 30%, they might take half of their assets out, whatever it is, right? Once they lose 40% or more, like a 2008, it might be the last conversation you have with that client. They might pull their assets out and go invest in a 1% C to bank at the absolute worst time. That's what leads to the Dalbar study that was mentioned earlier. The last 20 years, and this is on the next page, the average investor has averaged only 2.3% per year, or barely beating inflation. While the market's been up over 7%, the S&P 500. How do we avoid that? We avoid that by adjusting how your clients are invested based on what's going on in the market. So meters more of your safety net. We limit some of that downside, and we pair very well with those strategic mutual fund managers or ETF managers available on the Lifetime Investment Platform. But we are here to smoothen out the ride for the client and still get them to their destination. So if retirement's 5 years away, or sending their kid to college is 5 years away, or 10 years, whatever it is, they are okay limiting some of their upside potential, knowing that a 40% crash in the market, they are not going to experience, and they're not going to have to change their life plans because they were too heavily invested inside the equity market. So the older or more conservative a client is, the more they should move to a more tactical type approach. And the younger or more risk tolerant they are, the more they should have in a buy and hold type strategy. And I know Tracy's going to touch base on pairing managers right now. But any questions for me tonight? Yes?
Where do we get this kind of material?
So this material right here you have to request from us, but everything else is available on the POL.
This is actually available in a PDF, client approved on the dashboard.
It is, okay.
So you can go there, get it printed out, you can email it to a client. But if you want the pretty glossy, you can order those from me here. Is there a number?
Yes, I will just give you, are the cards not inside the kits? I will give you mine. So I'm going to give you guys all my cell phone number so you can get a hold of me. This is the best way to get a hold of me. Maybe the wrong number. Don't call that one. 614-499-5944. Like I mentioned, I cover the East Coast, so I'm like Maryland through South Carolina, and I get Tennessee. I'll be more than happy to get in touch with Justin for you, and I do have a handful of his business cards as well. But reach out to us, let us know how many kits you want. I believe most of the RVPs have some of these as well, but I'm more than happy to send more. Yes?
Do you? I have some that similar chart to say like what 401Ks have done? Do you ever do a comparison like that?
To what? To what we've done?
Right.
So this study is actually a Dalbar study that's done on all asset allocation mixtures. So it doesn't matter if it's inside a 401k, a 403b, non-qualified money, it's all managed money. All asset allocation money. So it's mutual funds, portfolios, managed money, it's all. It's clients investing their own money. Does that answer your question?
Yes.
Okay. Thank you for having me. Thank you for not making me dance. And if you need anything, let us know. Okay, guys? Thank you. Oh, yes, I didn't answer the performance question if you asked it. Yes. So we do have performance numbers dating back to 1974, and we can share them with you. Now, the 1, 3, 5, and 10-year numbers are all inside that white packet. If you want individualized annual numbers, you'll have to have a conversation with how we can get those to you. But we do have them dating back to 1974 on that same strategy. Thank you for that.
All right, everybody doing good? Yep. Stretch? Yeah. All right. Let's talk through this, some kind of presentation techniques. But, to kind of, sum it all up here in the last hour, what managed accounts really is at the end of the day is it's a process or a system of client engagement to create an investing plan for a client. And that is very different than other methods that clients can use to implement an investing plan, right? They can do a do-it-yourself approach, right, where they have to come up with it. They have to figure out every aspect of it. And it's not very systematic. It's not really a process because most clients, they don't understand how to approach it. They let emotions often govern it, right? We just see this in the Dalbar study and the results. The other way is you can purchase a mutual fund or an ETF, from a registered representative. You can go into this product that in many ways is a siloed approach to investing because this individual mutual fund is typically investing in a certain market capitalization range, or it has one investing theme to it. Maybe it's income equity, for example, or it's just fixed income. But it's again a bit of a more siloed approach to investing. Or you can go into a managed account with a financial advisor, with a professional asset manager. So we call it a process, a system of client engagement. And if you look at the definition of process, if you're kind of trying to think through this, a process is a series of actions or steps taken in order to achieve a particular end, right? So if the end goal is I want to be retired at age 65, I have to take a series of steps, a series of really focused actions, right, in order to get myself to that retirement goal that I have. Another way you can say system, so it's really up to you what you think your clients will understand, what makes you feel comfortable. Either one works. But a system is regularly interacting or independent group of items forming a unified whole. In the managed account, we're looking at the whole. We're putting a whole bunch of different things together and looking at really the whole person and what that individual really wants to accomplish, what their family wants to accomplish. And there again are a number of parts of this system. Phil talked about the car, right? The cars have different systems on them, right, that make them operate. I was just, for the last 4 or 5 days, I was driving around in a little Toyota Yaris. It's a little tiny car, no bells and whistles on it, nothing. Today I'm riding around in this great Ford Escape SUV, all these bells and whistles, all this kind of stuff, right? One is very functional, one is a lot nicer. They're getting me to my destination, but the systems of that car are very different ways of getting me to my destination. And that's what Phil was setting out in terms of the strategic car and the tactical car. But these are those sets of action steps or interacting parts that are going into this managed account system. One is the relationship with the advisor. So in a managed account process, you're going to have a relationship with an advisor, an ongoing relationship. And I know this might be a subtlety, thing that may be hard if you're looking at a transition from retail to managed accounts, because you've always been giving your clients service. You've been going above and beyond, but you haven't necessarily been being compensated for all that you do in it. But you can do more for your clients with that there. But it's an ongoing relationship with the advisor. It's getting access to a professional asset manager. You simply cannot get access to the types of money managers in retail that we have access to in this kind of a managed account process. There are managers like Meter who don't participate in commission funds. They don't believe that they should create mutual funds and pay a commission, that as a product manufacturer, they want to be part of a fee-based system. They want to be part of a client knowing that they're paying for this advice from them. So there's a whole different realm of investment management that we can get access to in a managed account process. It's continual alignment with the investment plan. We're talking about continually being able to adjust the client to have the right investment plan, to be in the right risk profile of a model, to be with the right manager, to be in the more active manager with less risk controls when they're in accumulation, and then when they move into preservation, be with the one that has those risk controls. Or when they're in income distribution, be with the manager who's now not going to think so much about maybe their risk profile, but think more about their longevity, think more about inflation, making different adjustments for that client. So it's being able to continually, without any expense, to be able to make those adjustments. Diversification and risk management. Being able to have access to a diversified model, to be able to use mutual funds, be able to use exchange-traded funds, to have these risk management controls of tactical, being able to go out to cash, and always having a sense of accountability and transparency. In this managed account process, all holdings are very transparent. Every action that the manager is doing is transparent. Can you see in mutual funds every single thing that's going on, like Meter just presented to you in that investment view positioning piece? You can't. You have to wait for the semi-annual report to see what they traded, to see what they did. With Meter, with Invesco, with Sage, with Horizon, with any of our managers, there's complete transparency. Your clients can go onto the client portal and see what was bought and sold. You will have trade rationales to talk through what was bought and sold. We have complete transparency and pricing. So clients always know where they are, where they're going, what they're doing. If there's anything that's in the road, if the dog or the snake are in the road, right, it's going to be transparent that it's there, and you've got a mechanism in this process to navigate around it. So if we dig a little deeper, you're going to have access to this PowerPoint after Wednesday. But what I've done is presented talking points that you can talk through about, what does it mean to have a relationship with the advisor? What is the responsibility of an advisor in a managed account? And this is your responsibility, and one that you can talk through with your client that again sets it apart. Number one, you're the cornerstone of this relationship with the client, right? You're the centerpiece. You're coordinating all the traffic, that goes on in the client's life. You know everything that's going on. I'm trying to get these kids to college. I'm trying to, deal with elderly parents, trying to, save for retirement. I mean, whatever it is your client is going through, you know the multifaceted issues that they face, and you're there to help them with that. You are a fiduciary whose responsibility is to put client interests first. When you pass that 65, you become a fiduciary to your client. Whether it's a qualified or a non-qualified account, you are there and you are putting clients' best interests first. And this is fulfilled by the fact that you're not paid any more or any less because of what manager you choose on this platform. That 1% that you decide to charge for advice is the same whether you pick Meter, whether you pick Invesco, whether you decide to make changes and go all in on Horizon. It doesn't matter. It's about what it is that's important for your client. It's always aligned with your client. You're going to work to identify their goals, needs, their preferences, their risk tolerances. You're going to work to help them choose the manager, and you're going to assist them with any changes that they need along the way. It's a comprehensive role. It's a compelling role. It's a really needed role. The role of the professional asset manager is to manage the portfolio. It's to decide that asset allocation. Just like Andy said, it's to decide the why. It's to decide the where. It's to decide the what. It's really all of the manager's jobs on the platform. Create the asset allocation, determine when to buy, determine when to sell, determine the individual holdings, and use the dedicated firm resources. 100% of this firm's resources is going into monitoring these markets, managing these markets. It's not something that you can do. It's a full-time plus job for the money manager. This whole notion that we talked about earlier, right, of the fact that an advisor could also be portfolio manager, that they think that they can do that. No. We're clearly setting out in the managed account process we believe in. It's an advisor and a money manager. And moreover, by doing this process promotes an emotion-free approach to investing and manager selection. It's about who do we need at the right time to execute the investing plan, right? You don't have to be emotional about it. The client doesn't have to be emotional about it. The manager isn't emotional about it. Everybody's got their job to do, and they have to execute it. Alignment with your investment plan. So the goal is to make sure that the investment models you select are aligned with your goals, preferences, and risk tolerance. So in a managed account program, the client's advisor can select a professional asset manager based on these factors. Your clients are not going to wake up tomorrow morning and go, I have no idea why TK put me in this manager. I have no idea. They're not going to wake up and feel that way. Like half the population feels right now with their advisor managed account going, I have no idea why I'm in this. I have no idea what these securities mean to me. They're going to understand that. The manager selection process should be transparent. So we have tools, right? I showed you the filtering tool. I showed you the compare tool. There's all these tools to help you in this selection. The managed account, all the holdings are shown daily in the custodial account. You're not hiding everything. Everything is out there for the client to absolutely see. And the ability to change managers and models is a key benefit. The great thing is it doesn't cost anything. You know what I've seen in these advisor managed accounts is the advisor will come and say, no, I really think we should make a trade. And the client's going, well, how much is that going to cost me? Because there's usually a transaction charge of some kind. That's not happening here. It's all covered under that comprehensive fee. Diversification and risk management. Professional asset managers are focused on diversifying their portfolios. They don't concentrate all their assets in one asset class. We're not just hiring a large cap growth manager. We're just not hiring a small cap value manager. We're hiring someone who's looking at all of those asset classes, investing in all the asset classes and moving with those asset classes. We can manage risk through various approaches to asset allocation. We have the tactical asset allocation, the strategic asset allocation. Managers are going to use different investment philosophies and processes. So it really does boil down to what Andy said. We have valuation managers on the platform, we have fundamental managers, and we have multidiscipline managers. So these are really the three philosophies. So valuation is looking more at price, and is an asset class worth the $10 that it is, or is it not, you know? And fundamental managers are looking at the underlying companies. You know, is the Apple phone gonna go well? Is Amazon's purchase of Whole Foods going to profit them? I've eaten there 2 times in the last 2 days, so I'm helping their profitability. The cookies are amazing. Multidiscipline, fundamental, valuations, momentum, trend factors. So these different philosophies come together and they interact and they work in different ways. And then this manager is continually monitoring their investment models. They're devoting significant resources to this and making those changes where needed. So, and the final thing is accountability and transparency. So again, one of the key benefits of a managed account program is the level of transparency and accountability. Each of the holdings is purchased, you know, within the brokerage account. For the ETFs, clients own those as their individual cost basis. They get tax management benefits out of those. There are various things that you can do when the client owns those. You've got access to statements and performance reports. Client can call you up on a daily basis and you can share the performance of the account and what the managers are doing. And the fees of the program are really transparent. So it's easy to evaluate if the advisor and the manager are offering value to your life. You know, this process should be adding value to clients' life. I mean, I think Kiara would have outlined, you know, in all of these components of the managed account system, right, is that it's all about adding value to the client's life in every aspect of their investment plan. So that, you know, that's what a managed account program is all about. It's about really bringing all of these aspects of a true investing plan to the client on a daily basis. Every day, every hour, right? There's a focus on their money, on their investing plan. So the question, you know, for clients is, you know, are these things that you want part of your investing plan? You know, you could do it yourself, you could go into a singular investment, but could this process really help you? And so if clients are nodding their heads and saying, absolutely, the process can help me, okay, well, if the process can help you, we probably have some features here that could probably help you too. So if you're dealing with that client, you know, who has grown maybe, you know, from that $5,000, right, that maybe they started with you in that original investment, in that original IRA, and now down the road here, that's built up and we've got a couple $100,000. You know, as you look at the different features, you know, we have, this is retail, this is freedom, this is lifetime. So if we go down the list, you know, platform features, I mean, some of these are more relevant to you than maybe to clients, but advisor dashboard, you know, that's important for you to have. You've built up client assets, you want efficiency in managing your business, you want to be able to really look at these client accounts and understand where you want to make changes. Advisor client website portal, you know, you have some, you know, website portal, you know, through shareholder services, clients can go and look at things there, but not as fully robust as a TD Ameritrade investor client portal, where now clients can go, they can look at their balances, they can get their statements, they can get their tax reporting all in one place. They're notified with an email when their client monthly statement is available. If they have what we call a non-program account where they can go in and manage the assets, they have the complete trading ability to do that as well. Mobile flexibility, phone and tablet, TD Ameritrade Investor Portal is accessible through phone and tablet. That may be very appreciated by some clients. Portfolio construction software, we've had that in Freedom with the proposal. We have that in Lifetime for you to be able to put multiple models together. Our client profile questionnaire has gone from 8 questions down to 3 questions. This is what robo-advisors are doing, how they're profiling clients, so making it easier, making it more efficient. Flexible model selection, you have complete flexible model selection here where you do not have it in retail, you do not have it in Freedom. Again, Freedom, you had 1 set of models, you had 1 manager. In retail, you know, I know in retail, in some sense, to make it efficient for clients and cost effective for clients, you have to look within 1 family, 1 fund family, rights of accumulation. You know, here again, because there is sort of no cost issue, right? You're free to roam. You're free to be as flexible with that client investment plan that you can be. The question you have to ask yourself is, could clients benefit, could this particular client benefit from having the diversity of these managers, having the diversity of this asset allocation, versus being in 5 funds from 1 specific fund family where there's often overlap and redundancies. Preference filtering, we have that in Lifetime. Multiple strategist blending, technology-guided portfolio solutions, rebalancing across products and strategies. We have account allocation rebalancing, and we have the managers rebalancing. So if you go into 2 managers 50-50, we're going to rebalance back to that target. The rebalancing in Freedom is with the fund families. You have some rebalancing features, but it doesn't have discretion to it. I think discretion is incredibly important because, again, these managers, if they need to get out, they need to go to cash, they've got the discretion to do that. And you've got discretion to be able to go in and change those models, change those managers if you need to do that. We have e-signature capabilities, ACAT transfers. Again, you know, if a client's sitting on the fence and they're like, wow, I'd really like to have that managed account process, but I just don't want to go to my other advisor and fire them, you can say, well, we have ACATs. You don't have to call your advisor. We'll just get this paperwork signed, we'll initiate it. Those assets will be over here in 5 days. So if you're working with a firm that's on the ACAT list, nobody has to call. That eases the burden for clients. That makes it much, much better for them. We have non-program accounts. We have the ability, you know, for clients who want to hold low-cost basis stock. Somebody called me right before I came over here and said, I have an 80-year-old grandma who has 3 holdings. She wants to consolidate everything. Can we get her in the TD Ameritrade, move those 3 holdings? 2 were at Wells Fargo and 1 was at CompuShare. Let's get that all together. Let's get our Lifetime working. Let's get the non-program working. Hold those 3 stocks. She knows where everything is. It's accountable. It's transparent to her. We solve problems like that all day long for people because of that non-program account capability. Trading is embedded in the platform, customized statements, billing reporting, performance reporting, detailed cost basis reporting, flexible advisor fee processing. These are all the platform features that Lifetime is bringing to the table. if you're asking yourself what client is suitable, a client who has $25,000 who wants this rich feature set of services is eligible for this, is a match for this. If they don't want any of this, great, work off the blue line. You know, sorry, this is no longer available, you know, but work off the blue line or work over here. It's your choice to determine, you know, where they go. And by the way, I didn't put this together. One of our great managed account advisors actually took the liberty and put this together. So this is from an advisor's eye on the feature set. This is investments, what you get in investments. So mutual funds, mutual fund investment latitude. The mutual fund investment latitude is unlimited. You listen to this again on Wednesday, you're going to hear what Nestor White and Mike Maddox, who are two RVPs out of Florida. One is an older advisor, one is a younger generation advisor. They are both just absolutely motivated and excited about what they can do for their clients. And Nestor will talk to you about his views on this investment latitude that exists for clients of literally being unlimited in terms of where these managers can go for investments. Exchange traded funds, alternative investment options, asset allocation styles, investor life cycle approach, model ranges, intraday liquidity for the ETFs, income distribution portfolio strategies that are automated, that are systematized, lower ownership costs, tax cost ratio benefits. I mean, rich, again, investment features that can act like a checklist for you. Do my clients need this? Do they need ETFs? Do they want lower expenses? Do they need more tax control? Do they need income distribution? You know, if the answers are no, no, no to these things, super, then retail's the right place. But if they're yes, 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 then you know you're going down the right track with this process. And then the final thing is the responsibilities. And again, whose responsibility is it? Is it your responsibility? If it's your responsibility, how do you take care of the client and grow your business at the same time? It's your responsibility. So in this, you can see on the retail side, all of these responsibilities around portfolio management, selection, belong to you. But in lifetime, these can belong to the strategist managers and take all that off your hands, right? And allow you to just focus on the client, focus on the investing plan, focus on making sure the system, the process is always working for the client. How's that feeling to you? Is that making more sense? Connecting the dots. It's really, at the end of the day, it's going to be about a checklist for you. Client has $25,000. Am I going to go retail? Am I going to go managed? You know, does client need a process? Do they need a product? Do they want recurring? Are they willing to pay for it, ongoing advice? Or are they not? You know, if you can get past that, and it's now tracking to process and to these feature set that they want to tap into, then it's get into the discovery process of what are their goals, what are their preferences, and start working down the filtering to find the manager that's aligned for them. So from a pricing standpoint, here's what it looks like compared to Freedom. And so as we think about, you know, are there clients in Freedom that we need to think about moving to Lifetime? Here I just kept that 1.25% constant. So the 1.25% in Freedom, that's a 1% fee, 25 basis points coming from a 12B1. And so now the whole 125 will actually come from the client. Now they'll be paying that. In terms of maximum asset management fee, in Freedom, Lockwood was charging 25 basis points. Now in the new Lifetime platform, we have Basically, we have 2 mutual fund managers, one in Meter at 0, Morningstar at 20 basis points. We have Lockwood, which is a blend now of mutual funds and ETFs at 20 basis points. And ETF, we have Invesco at 0, or Sage and Horizon at 25 basis points. We did not have a custody fee in Freedom, okay, and that's because this was a product, it was not a platform, it was not a process. And we picked up so many more new, richer feature sets by adding in the 52 basis points, which is 10 basis points for custody, 42 basis points for administrative costs. The fee on the client statement was 1.50 with Freedom. The fee the client will see is slightly more, about 1.77 to 197, 177 to 202, again, depending on which managers you pick. But our investment expense ratios are on the decline. So today, those investment expense ratios are at 110 basis points in Freedom. They go down to 84, 65, or 29, depending on who you choose. So you actually sort of wind up fairly even to cheaper in your transition. But you're giving the client more options, more flexibility to do the things that they need to do to make their investing plan work across that life cycle. You know, Freedom was really designed for the accumulation, preservation client, and really not even for an accumulation client that wanted a lot of risk. It's a very risk-averse, risk-managed program. Now you have the opportunity to have managers who can work towards accumulating assets, work towards that preservation, and work towards that income distribution. And, you know, an easy transition, you can always go Freedom to Lockwood and talk about, again, lowering those internal expense ratios, getting rid of those sort of double distribution costs. This is an illustration if you were to drop your fee to 80. You know, if you didn't want to continue with the 125, you could drop it to 80, and you could see that that makes a big material difference in the all-in costs, definitely drops those transparent costs. Okay? But you have that range between 80 to 125. Now, from an industry comparison, this is Primerica here from an industry standpoint. So if you were to charge 1%, you were to charge the highest manager rate we have, which is 25 basis points, 10 for custody, 42 for admin, you'd be at 1.77. Now, just so you know, our highest platform fee on our platform is 2.02. The wirehouses for accounts less than $1 million charge 2.7%. Okay, we are so much cheaper than the wirehouses. Now, Merrill Lynch decided that they would reduce down to 2.20. The thing with the wirehouses and the regionals is they bring no transparency to the table. They will not disclose what their advice fee is. They will not disclose what their program fees are. They will not disclose their manager fees. They mark up their manager fees to 50 basis points. They contract with them for very little, but mark them up. But they are on a household pricing schedule, and they have not changed that in response to the Department of Labor rule about revealing conflicts. So clients are never going to see at Ameriprise, which this is, you're at 2%. They charge extra for ETFs, an extra 50 basis points. We don't charge extra for ETFs. We have an insurance firm here, which is Mass Mutual. Again, they have a supermarket platform, so their management fees are going to range anywhere from 10 to 80, 100 basis points. They charge extra for ETFs. Their custodian is Fidelity. It's not integrated. They charge an extra 27 basis points for ETFs. We have IBD insurance firm. This is LPL. LPL and AXA advisors, they work off the same platform. They use a lot of proprietary research, so they might have manager fees that are at zero, but then they charge a lot of custody and clearing. But again, the internal research group is never going to fire themselves at all. And these last are these IBDs who again work off the same supermarket platform with a pressed logo onto the platform. And you can see where the prices range, and again, charging a little bit extra for ETFs. So that's the one thing with us is we do not charge extra for 3 managers in the same account. We don't charge extra for ETF. We don't, and one of the things we're doing is you can actually even get our prices lower. You can get these lower because we'll be doing household discounting starting next month. So if your client has 3 accounts and they add up to $500,000, for example, each one of those accounts is going to get your advice fee rate at $500,000 if you choose, and they will get the admin fee rate deduction at $500,000 across each of those accounts. Even if one account is 25, one is 125, and one is, 75. They're going to get whatever that $500,000 discount is. So with householding, not charging for these extra services, and also no IRA fees, no termination fees. So on the retail side, you have that IRA fee, you have account termination fees, you had some of those in Freedom. All those have gone away for lifetime. So we are incredibly industry competitive. We will continue to be competitive. This summer I had an intern in, I had him pull all the ADVs. So I did this analysis a few years ago. Nothing has changed in this industry. Everyone has stayed the same in their pricing, with the exception of Merrill going from 2.7 to 2.20, which is still higher than our maximum platform fee. We're incredibly competitive in this industry. So this is Edward Jones. The thing you need to know about Edward Jones is that Edward Jones is highly proprietary. Edward Jones has their own research group. They build their own models. They create their own funds. They're called they're called,
Hey Tracy, can you go back one? I'm sorry. I'm gonna, and Phil, tell me if I'm wrong here. But Phil's done a bunch of research on this. Has anybody got more than 4.2 million in this thing in the room? So he's kind of, I would say, the expert. I'm sorry, which slide do I want?
do you want the industry slide
Yeah.
or the Jones slide? Okay.
Yeah, so if you look, the industry. So if you look at Primerica Advisors, it's 1.77, but the portfolio he's using, and I've started using, he's got a lot more than I do, that management asset fee is with, if you do 50% meter, 50% Invesco, that's a 0. So
Yes,
now I'm
it'd be
at,
at 142.
yeah, so now you take 25.25 off of that, you're at 152.
Two.
That's lower than anybody else I see. You've got better products and better service, so nobody can touch us here. Now,
And if
you
wanna
use what
drop
you want,
this
but
to
I'm
80,
going with that, and
You want to drop that to 80, because 80 is better than 25, right? You're at 132.
nobody can touch us here. We just gotta get out in the field and start talking to people about this.
So people are literally paying robo-advisors 50 to 80 basis points with no advice, market capitalization, ETF portfolio, highly weighted in some of the most riskiest stocks. They would be willing to pay an extra 80 basis points to get active management, get choice, flexibility, diversification, and the role of an advisor in their life. More than willing to do that.
Plus, you're gonna ask them how their kids are doing, and these other idiots don't have those skills. I'm totally serious.
That's right, that's right.
I am totally serious.
No, you're gonna engage fully in the family, and you're also gonna really teach everyone something. And they're gonna have a purpose, and they're gonna have a plan, and they're gonna really understand it.
And a
But I
financial
understand
needs
that Edward
analysis for
Jones,
free.
it's really proprietary. And so they're charging, 135 plus, 9 basis points, admin fees for about 144. And the bridge builder funds are proprietary. We've done extensive analysis on a lot of these portfolios that have come in with bridge builder funds, ETFs, and mutual funds, where clients are more paying in the 185 range, and our managers beat them with lower cost. So, you know, that, again, with your due diligence message of independence, objectivity, you know, and Edward Jones advisors that have been there less than 4 years are paying all of their expenses and only getting about a 27% payout. So there is a lot of interest in what we're doing here among Edward Jones clients and among Edward Jones advisors. So highly competitive. You should have no problem pricing this, hands down at 81%, more than fair for everything that you're going to bring to the table in this process. So tools that we have available to help you is what you have in front of you. You have the client brochure, you have the due diligence presentation. If you like something that's more in a presentation format, we have a flip chart PowerPoint book that goes through this, and you can customize the client cover. We have the proposal. Again, here on the proposal, it's going to, again, be an executive summary of what you and the client talked about. One of the things that gets clients so upset is they do these huge fact finders. They pour out all this information to their advisor, and then when they get the playback, there is no playback. They're like, I have no idea how we went from this to that. This connects the dots. It says we chatted. You told me you had $75,000 to invest. We profiled you. You were conservative growth. And so because of everything we talked about, I choose the following managers. So we talked about how you wanted to go to cash. You wanted a tactical manager. You were in your accumulation life cycle. You were interested in ETFs. But we also talked about strategic. And we talked about mutual funds. We decided to pair these two together for you. And so the proposal will go over the account allocation, Sage and Morningstar, Invesco Meter, whatever you choose. It'll go over the services of the platform with the pricing clearly outlined, so you can go through and you can talk through, hey, if you bring me 3 or 4 accounts in the same household and they add up to 500,000, you know, this is going to be the price, this is going to be the admin fee drops to 40. You can talk about and use this fee schedule to find discovery on where additional assets are. Some of the 2 advisors that are going to be on the call on Wednesday are going to share with you how they have been finding additional assets by putting this fee schedule conversation to work and by talking about these new capabilities. They're finding assets that they didn't even know existed from their retail and their freedom clients. It's going to show the asset allocation blended, so the 2 managers together, and then so that they can see the comprehensive portfolio and what it's about. And again, you've talked through the diversification, the risk management. This is the implementation of that. And then we have everything you need on the dashboard. Managers are doing the trade rationales, like Meter's doing their investment positioning. What's happening in these portfolios, the transparency of these portfolios, are available to you constantly. You'll get an email if a manager makes trades, so you'll get a trade rationale, email, and so you'll know. So if your client happens to log on to the TD client portal and says, hey, I saw this transaction, you're gonna already have the intel to know how to answer that, to look smart at all times. And we've got those client letters up here on POL for you, and they're also on the dashboard. So you can go in, if you want to use a client letter, you want to use these as scripts, introduce the Lifetime platform, introducing Lifetime to Freedom clients, introducing access to managed investments. Different languaging in these letters, up to you to use them. You know, if you like them, you're like, hey, I want to modify this, you know, feel free, you can modify it, but you got to send it to advertising compliance. What we've written here for you has already been approved. You just got to put it on letterhead, pick it up, use it on the phone, you know, as a script, okay? So lots of resources to help you in this. But I think, you know, those advisor testimonials, what Phil did today with his stories, I think what you're going to hear from Nestor and Mike on Wednesday. If you can't make it at 4 o'clock Wednesday, we're definitely going to, you know, to have that recorded, and we'll have that recording up there. So we have a couple minutes left. I can just show you some quick case studies that we worked through, and how did we, you know, bring a client through this process? How did we think about pairing a couple managers together? Do you guys want to go through that real quick? Yeah.
I think you said the client may have some input on how they may want to request a state tax trade. Is that what I understood you said?
No, the client has input about their preferences, their goals, to say, hey, I'm not sure I'm liking this manager, maybe we need a different manager. Clients can't direct what the managers are doing. We do have that non-program account for clients who do want to trade securities, or do want, you know, to trade options, or they have low cost basis stock they don't want to sell. They can use the non-program account at TD to do that. You don't get paid, you can't manage that, but it's a nice place to collect all the assets. Because what's going to happen here over a year or two is, as these assets sit on this other side of TD, they're going to be coming to you as the advisor and saying, hey, I think I want to sell off some of that and put it in Lifetime. I think I want to do something with that. You're there. It's not just on paper that you know that the clients exist. They're there. They're close to you, and all we have to do is flip a switch and move them over. That gives you a lot more control in the client experience. See what I have to go through with compliance? 6 versions to get the winner. Okay. Okay. So, couple client cases here. This one, client came with $150,000. Okay, it's an individual qualified coming from an IRA rollover. Okay, more than qualified, right, for a managed account process, you know, or a retail product, right, one or the other. But in this, you know, the advisor thought, okay, you know, his client's profiling is moderate growth, they're 60-40, but they're really focused on preparation for retirement, and they're really fee conscious, okay? So is there something in Lifetime, you know, that could potentially work for them? So it was discussed that we should look at 2 60-40 models, one with Invesco, one with Meter. And for the Invesco, the notion was, okay, we have a strategic ETF asset manager. This client's preparing for retirement. Risk management is really important. worked super hard to accumulate these assets, does not want to suffer that loss, right? Just like we've talked a couple of different times here tonight, it's harder to get back up, right? It's harder, you gotta run even faster, right? You get behind, you gotta run faster to catch up. So protecting this client assets is really important. So we're gonna use the low volatility factor to minimize risk in that portfolio. As Invesco will often say, we have a low brake pedal that we're gonna put on that car. We're gonna sort of plug up the hill in San Francisco, but we don't wanna just, whoo, go down the hill. We're gonna use our low volatility to break us down that hill. The client's gonna own the own cost basis of ETFs, so even though this is a rollover, just the fact that there isn't any capital gain distribution here, just the fact there's no herd mentality, right? For a client who's in retirement, you've grown your assets, the notion of sort of having individual control is really important. It can be very validating for someone like that, and no manager fees. So we're lowering the costs in the ETFs. We're probably looking here at about maybe 33 basis points of internal cost in the ETF model and no manager fee on top of it, right?
When you do that, is it still considered a qualified, or do they lose that coverage of being tax averted?
No, they do. They're still in qualified status. But a lot of qualified clients, they just don't like the idea that there's another shareholder kind of controlling their performance, controlling, expenses in there. I mean, those internal expense ratios still exist, and in a mutual fund, structure, regardless of qualified or non-qualified, there's still this herd mentality going on in there that's affecting the performance. If shareholders are getting in and out, it can affect performance. So these individual ownership benefits can be very important at the end of the day. So for Meter, we said let's combine with tactical because that's going to be adaptable and flexible in asset allocation and holdings. And Meter's going to continuously monitor for risk and can move some of that portfolio to cash or move all of it to cash if volatility is present. These are levers of control that just simply were not existent on the retail side. And so it did not make sense to go in that direction when you could get this kind of control and more precise management of what was trying to be accomplished. And no manager fee. So while we still have a little bit of higher expense ratio here, probably on average about 85, we're cutting the overall portfolio expense because of that Invesco exposure. So the overall objective for account allocation was client could benefit from the lower costs of ETFs in the portfolio. Both managers do not charge a manager fee. Again, another way to lower costs. Both models have a strategic asset allocation, but both have some risk management technique built into the portfolio. So, Andy didn't, exactly express this, but, when Meter sets the weights to their mutual funds, they're not moving in and out of those funds. They're moving inside of that fund structure, which is saving the client, a lot of turnover and trading costs. So diversity in investment vehicle, we have ETFs and mutual funds. Diversity in investment philosophy, we have fundamental, we have valuations, we have trend following. And diversity in standard deviation and beta. We did not get into risk statistics, but if you were to go to the manager blend menu on POL on the dashboard, you would see that they have a diversity in how their beta looks and how their volatility against the peer group, the volatility against the market looks. And that's a great way to diversify as well. So this is what was presented to the client, right? So the client came and said, these are the things that are important to me. These are the things I'm worried about. I'm worried about my retirement. I'm worried about fees. I'm worried about how I'm going to get this done. How am I really going to be able to get to my retirement age that I want, right? So that's the problem. You're going through your checklist. You're saying, what can I do in retail? What can I do in retail to help with that problem? What can I do in managed account program to help with that problem. All roads led here, so now it's, okay, can we find in the managed account program the manager combination that they needed? And so we were able to bring that meter and Invesco together and create a rationalization for why that made sense. So when this was presented to the client nodded their head and said, yes, that makes sense, let's go. Okay. So sometimes even diagramming it out like this can be helpful to you, because you're just rationalizing it. And you've got the proposal to kind of back you up, with the pictures and the transparency of it all. This one we got a little larger, so now we're going on to 500,000, okay? Individual, non-qualified, growth, 80/20. This we had a client who was actually focused on accumulation, very tax sensitive, very concerned about risk. So now we have a lot of factors, here at work that we have to think about. I've seen this happen with clients at 25,000. You don't even have to really look at that AUM, but you can have a 25,000. I had a 35, 40,000, who have this issue. And so you have to, just path through it. So here, we wound up doing an all ETF portfolio, okay? Because with a taxable investor, we're really trying to control those taxes. We're trying to give them as much individual ownership over the cost basis as possible. Same reasons, with Invesco as the last case, but we added in this horizon because here they were tactical, but they're using ETFs, and they have a risk assist, which is where they will go to cash. They monitor volatility, and they have an algorithm that will take the portfolio to cash. So ETF stock ownership, tax efficiency, smart beta factors, and the ability to move the portfolio with cash will help the client manage through the volatile moments. Asset allocation still maintains the ability to grow assets while minimizing risk. So we were able to take them up into an 80/20. A lot of people might just naturally think I got to go to a 60/40 or a 40/60, right, to be able to manage my risk. But you don't have to. If you have these risk techniques built into the portfolio, sometimes you can take a greater equity to bond allocation because you've got the risk management techniques in there. So you can do that with meter as well. You can go up a notch because a lot of clients, right, to accumulate, they need that greater equity exposure. They can't be fearful of that. If they go into bonds at too early of an age, they're going to fall behind, right, for their retirement. This is what we see with a lot of people in retirement. We're having to go into greater equity exposures to get them to the spending rate. So this is too where these can really, again, you don't have these things on the retail side. You can put these levers of control to work here. And then the last one, this was a big case. This was like $8 million, okay? And in this one, this was a gal who, this was going to be individual, non-qualified money. She had, given her husband, a lot of leeway over the years. He had sold a business, come into quite a chunk of money, and he wound up losing it all, trying to manage it himself and do it yourself. He built himself back. He sold another business. He's now got this wealth, and she said, you give me a pool of money of that, and it's all mine. And so, this is where, again, okay, we can build a customized plan for him, and we can build a customized plan for her. She's like, I just want to go all conservative with my pool of money. He's like, I want to be aggressive, and I need to have the non-program account, and all this. Great, we can play to what each party in the household really needs to do. That's fine. So for her, conservative, 20% equities, 80% fixed. She wanted to make sure she had funds for immediate distribution. This was going to be, her spend account, her savings account, and she's like, take whatever money you want, this is mine, right? And she wants to preserve the assets and manage risk. Horribly scared of risk, horribly scared of loss because of what they've been through, And I think that kind of recency bias, that kind of, fear, again, that enters into, a $25,000 client. You know, I had a widow, $300,000, and just, you know, had this pool of cash in the bank, and just really scared to death to put that in any kind of investment. You know, and we showed her, you know, with a Horizon Real Spend, how she could have the cash and the investing plan and the risk management. And that just gave her so much confidence to consolidate it all instead of letting that $300,000 erode in the bank, constantly having to deal with the banker coming and asking her to put it in some variable annuity or lock it up in a CD or whatever, right? So when you're able to centralize things in a process, you know, for people, it can be very meaningful. But she was in the same modus this woman was. She only had $300,000, right? So money doesn't, you know, people feel what they're gonna feel, right? They have their emotions about that, and the dollar value doesn't necessarily matter. It's, what's important here is how we can help them process through this and help them really connect to the strategy they need. So for her, we did a custom model for her. We used our custom allocation to say, let's put 20% of this in Lockwood's conservative model, in more of, you know, the equity. And let's do Sage Multi-Asset Income, which is designed to give about 4.75% yield. It has a 20% exposure in dividend-paying stocks with the rest in bonds. Can be some high-yield bonds, things like that. But for her, she wanted that income generation in that. And Sage has a very conservative profile of fixed income, very strong track record in that. So we brought the Lockwood, the downside risk management, the active passive approach, the ETFs bringing down internal costs. You know, wealthy people are really cost conscious, you know, in that. Sage, you know, their fixed income heritage generating the yield. So we created an opportunity for her to generate income, dividends, and yield while modestly growing the assets, but the overall focus of the account was on downside risk protection and volatility management. You know, so, you know, another idea for her, you know, too, was the real spend. You know, that would give her that cash. She could see, feel, touch that 3 years of cash. And she would also know that she, you know, had plenty of money there for distributions in this low-cost ETF, inflationary protected risk managed portfolio. So again, at the end of the day, it's just, you know, understanding it's what it's always been, right? Let's understand what our clients are dealing with. Let's understand the problems that they face, what it is we're trying to solve for. Determine if that can be done in retail. If it can't, and the client really wants a process, they want an advisor, they want a money manager, they want this diversified, accountable, transparent plan, you know, then this is the pathway, and the filtering tool will guide you to the managers. Little clearer? Clear? Great. Thank you for your time this evening. I'm happy to stay for a few minutes and answer any questions that you have. But I really think this is an exciting opportunity for you to engage, to interact, to open up the doors, deepen the conversations, the discovery that's going on, and the problems we're solving for people. It just makes it really fun every day. So